Okay, let's proceed to the next chapter. Next chapter is departmental accounts. Okay, departmental accounts, a small simple topic it is. Here they look into the business from a micro angle. From a small angle, we want to look at the business so that we know where we are incurring losses so that we can improve. Imagine Ram and Co is there. It has three departments: mobile, TV and AC. Mobile 5 crore, TV 1 crore, AC negative 4 crore, negative 4 crore. So imagine the capital is 1 lakh. Profit for 2024 is 2 crores. Won't you be happy if the situation is like this? Yes, but when we see individually, then you feel that, oh, improvement can be done over here. Okay, distribution of expenses. Now, if there is rent given, usually it is distributed on the basis of floor area. Electricity given, it is distributed on the basis of lighting points or units consumed. And advertisement is there, it's based on sales. Carriage inward, so it is based on purchase. Carriage outward, so it is based on sales. Discount allowed is based on credit sales or sales. Discount received is based on credit purchase or purchases. Salary and wages is based on number of employees. Stock reserve concept you need to know. Stock reserve. What is stock reserve? Unrealized profit. We call this as unrealized profit. We had the stock reserve concept even in consignment. If one department transfers goods to another department at invoice price, that is cost plus profit, and the receiving department still has these goods in closing stock. One department transfers to another department and the receiving department still has these goods in closing stock. For example, department A transfers to department B. Cost is 100, selling price is 120. Okay, so this will be taken as sales. Department A will take it as sales and department B will take it as purchases. Department A will take it as sales and department B will take it as purchases. Is this clear? Now, if they don't sell it further, it will still be in the closing stock of department B. It will still be in the closing stock of department B. Now what we can do? Okay, business. For business, it is 100% not a profit because department A and department B both are ours only. So department A transferred, for department A profit, for department B it is cost. But for business, is it profit? No, because the goods are still here. Goods are still here. Therefore, this is called as stock reserve or unrealized profit. Unrealized profit you have to remove. Okay, if half the stock is there, then half the profit is unrealized profit. If 25% of the goods are there sold, then 75% of the goods are not sold. So 75% of the goods will be unrealized profit. And what is the entry for stock reserve? You have to remove the profit. So P&L account debited and stock reserve is created, which is a liability which will be reduced from stock. Okay, previous year stock reserve. If there is a stock reserve of previous year, that is what we are going to do. Stock reserve account debited to P&L. Stock reserve account debited to P&L. Reversal of previous year unrealized profit. This is reversal of previous year unrealized profit. Previous year, if it is unrealized profit, that means this year it is realized profit. That's why we remove it and we put it to P&L. This year unrealized profit, we remove it from P&L. Is this clear, guys? Yes, this is the topic of departmental accounts. Okay, very easy topic. Let's quickly look at a few questions. Okay, should be couple of questions, should be sufficient. Now, see over here. Unique is a departmental store having three departments X, Y and Z. Information regarding three departments are given X, Y, Z. What you are going to do, whatever information is there, opening stock, directly you will put it to trading account. Okay, and purchases you will put it to trading account, sales you will put it to trading account and closing stock you will put it to trading account. Can you see sales, closing stock and purchases directly given? Then sundry debtors not required. Okay, floor area is given and number of employees are also given and electricity consumed is also given. The balances of other revenue items is given. Now carriage inward. How will you apportion carriage inward? See, carriage inward is apportioned on the basis of purchase. Carriage inward is on the basis of purchase. Carriage outward, it's on the basis of sale. See, carriage outward in the P&L, it's on the basis of sale. 360, 270 and 180. Okay, then we have discount allowed. Discount allowed is again based on sales. Then we have advertisement. Advertisement is also based on sales. Then we have wages. Wages is based on number of employees. Can you see the number of employees? 50, 40 and 30. 5 is to 4 is to, sorry, where is it? 5 is to 4 is to 3. Then we have discount received. Discount received. Discount received should be based on purchases. Can you see the ratio? It is based on purchases. Then we have employees welfare expenses. Employees welfare expenses. Employees welfare expenses based on number of employees. 5 is to 4 is to 3. Then we have rent rates and taxes. Rent rates and taxes, on what ratio we are going to base it? The floor area that we have. Floor area is 6,000, 5,000 and 4,000. 6 is to 5 is to 4. Then we have electricity charges based on the units consumed. Electricity 6 is to 4 is to 2. Then we have depreciation on furniture. Depreciation on furniture, that will be based on, okay, what are you going to base the depreciation on furniture? Based on the furniture value. 4, 4 and here it is 4, 4 and 4. So depreciation on furniture will be, 4, 4 and 2. It will be based on the furniture values. So depreciation you're just going to analyze and apportion in that particular way. Is this clear? That is your question number 1. Then you have to calculate gross profit, net profit and all that we know. Okay. Here we have first time unrealized profit introduced or stock reserve concept introduced. Okay. The firm has 2 departments, raw material and manufacturing department. The 2 departments are raw material department and manufacturing department. The finished goods are produced by the manufacturing department with raw material supplied by raw material department. So, raw material department will supply to the manufacturing department and the manufacturing department will be the one who is manufacturing the finished goods. Okay. Using the following information, prepare departmental trading and P&L account. This is what they have given us. Now, what will you do? Opening stock directly to trading account. All things which are directly given, you are just going to put directly, and purchases directly given, you are just going to enter it directly. Then sales directly given, just enter it into trading account. Then you have manufacturing expense, directly enter it, 0 and 24,000. Then you have selling expense has to go to P&L. You can see it in the P&L here, 1,600 and 800. Okay, then you have raw material transfer to manufacturing department. If one department transfers goods to another department, for the department transferring, it is sales. For department which is transferring, it is sales, but the department which is receiving, it is purchases. Okay, so here you can see to transfer, raw material department is taking it as sales and the other department is taking it as purchases. Then you can see over here closing stock, direct item 80,000 and 24,000. Directly you are going to enter it. Now, cost of closing stock of the manufacturing department consists of 25% of manufacturing expense and 75% of raw material. Okay, whatever is there, they are telling 25% is of manufacturing. Whatever is there in the manufacturing department, no, they are telling that 75% came from raw material, 25% is their own expenses. Okay. In the preceding year, raw material department earned a gross profit of 10%. Last year, they are telling they earned a gross profit of 10%. Okay. Salary of 5,000, insurance premium 1,600, allocated between 2 departments in the ratio of sales. Okay, so we have to put the salary and insurance on the basis of sales. Now, everything is done. Now, from here, what we will do, we'll just transfer the net profit. End of the story. But stock reserve computation has to be done. Stock reserve. But stock reserve computation is usually done in the consolidated P&L. Stock reserve is for the entire business, not for departments. So you can directly do it in consolidated P&L. Now in consolidated P&L, what happens? Can you see over here, what is our closing stock? Closing stock of manufacturing department. Okay, closing stock of manufacturing department is 24,000. They have told that 75% came from raw material. So 75% is actually which has come from raw material department, which is 18,000. Now you have to find the gross profit ratio of raw material department. Raw material department gross profit is 1,60,000, sales is 8,80,000. Gross profit divided by sales into 100. you are getting 16%. So 16% is your unrealized profit. Pass the entry, P&L account debited to unrealized profit. Can you see P&L account debited to unrealized profit or stock reserve? Okay, same way last year also we have transferred, no? Okay, opening stock is 20,000. In that 75% went from raw material department. That means 15,000. But last year's profit is not 16%. Last year's profit, they said it is 10% gross profit rate. So into 10% you will get 1,500. Into 10% you will get 1,500. Is this clear? Yes. This should be it with that particular question. Let's proceed further and see if we have over here also. Okay, entire thing is about the stock reserve calculation. You will be able to apportion things. Now see in question number 3. Okay, in question number 3, they have told, see again, this table I am not discussing only. You are just going to put it over there. Okay, what is transferred, what is opening stock, everything is there. Goods from P they are telling. This one you will have to discuss. Goods from P. So what we are doing, one person is taking it as sales, other person is taking it as purchases. So if this fellow is selling, this fellow is selling to this fellow. So that will be little remaining in the closing stock. That will lead to unrealized profit. Okay. Now where have they told? See over here. They have told that where is it? Department P sells goods to Department Q at normal selling price. From the following particulars, prepare Department Trading and P&L account. Yeah. Now see the stock reserve calculation. What is the closing stock over here? 2,09,000. 2,09,000. How much is received from department? How much is received from Department P? Now how we are going to calculate? See over here. 8 lakh is received out of the other expenses. Their total expense is 11 lakhs. Out of 11 lakh, 8 lakh is received from other department. That means out of 11 lakh, 8 lakh is received from other department. Therefore, in the closing stock, how much is received from the other department? 1,52,000. Out of total 11 lakh, 8 lakh came from other department. So out of the closing stock, 1,52,000 came from the other department. Gross profit ratio we have to find of the department which is sending. The department which is sending, their gross profit ratio is gross profit divided by sales into 100. That time you are getting 25%. Okay, multiply and you will get the gross profit. When you multiply the gross profit ratio, you will get the unrealized profit. P&L account should be debited to stock reserve. Clear? This should be the situation. Okay, next we'll go into question number 4. Question number 4, when we are going, A Limited manufacturing electronic components operates with 2 departments. Transfer made between the departments of both purchased goods and manufactured finished goods. Goods purchased are transferred at cost. There are 2 types of goods here. Purchased goods, they are transferred at cost only, nothing to worry. But manufactured goods are transferred only at selling price. They are transferred at selling price. So if you're transferring at cost, you don't have to worry about unrealized profit and all, because profit only is not earned on that. But if it is transferred at selling price, then you have to worry about unrealized profit. Transactions for the year ended 31st March 2023 are given below. Okay, whatever is there in this table, directly copy paste into the trading and P&L account. Okay, opening stock, can you see directly? Sales, direct. Then wages, direct. Then we have purchases, that also you are going to put directly, 1,80,000. Then closing stock of purchased goods, closing stock of manufactured goods. Both are given, closing stock of purchased goods and manufactured goods. So this is your closing stock, that is also given. Now the following were transfers from department X to department Y. Transfer from department X to department Y. Purchased goods 6,000, finished goods 20,000. Department X is transferring to department Y. For department X we have to take it as sales, and department Y we have to take it as purchases. And then department Y to department X, purchased goods 5,000, finished goods 35,000. So department Y we have to take it as sales, and department X we have to take it as purchases. Stocks were valued at cost to the department concerned. Whoever is receiving the stock, he will take it at his cost only. It is estimated that the closing stock of manufactured goods department, closing stock of manufactured goods of department Y consists 20% of the goods received from department X. They are telling in department Y, 20% of the goods came from department X. You are required to prepare departmental trading and P&L account. Everything you have put. Consolidated P&L you are going to do. Department X. Okay, see over here. Estimate that stocks of goods consists of 20% received from department X. So department X has 20%, department Y has 20%. So what we are going to assume, both the departments 20%. Okay. This is received from department Y. This is received from department X. Department X has something received from department Y. Department Y has something received from department X. If something is received from department Y, who made profit on that? Department Y made profit. Department Y, when we are calculating the gross profit ratio, you have to go and check what is the gross profit. 52,000, for example, if you're calculating for department Y, 59,500 divided by sales. Sales to outsider, sales to insider also. You have to take this 1,35,000 because on that we have made profit, and we have to take this finished goods which is transferred also because on that also we have made profit. So can you see over here 1,35,000 plus 35,000. When I transfer to the other department also I have made profit. So on that also I have to calculate. Okay, gross profit is earned from that also. So you get a gross profit of 35%. Same way for the other person, gross profit is 52,500. 1,90,000 plus 20,000. We have made profit on that also, in that also. So 1,90,000. Yes, where is it? Okay, sorry. 1,90,000 plus 20,000. So you get a 25% gross profit ratio. So in our closing stock, their goods are there. So we have to calculate their gross profit ratio. In their closing stock, our goods are there. So we have to calculate our gross profit ratio. Inter-department, we have to understand this. One department transferred to another department, the goods are still here. Who made the profit in these goods? This department. So calculate their gross profit ratio. This department transferred to this department, so the goods are still here. Who made profit on these goods? This department. So calculate their gross profit ratio. When you're calculating gross profit ratio, your outside sales and inside sales where you have made profit, that also has to be taken. Purchased goods are ignored over here because purchased goods are not sold at profit. It is sold at cost itself. Okay guys, yes, that should be it. Okay, you can have a look at one more question, maybe question number 5. Okay. Now, all this information we are not discussing. We'll go straight into the stock reserve calculation. Okay. Breakup of closing stock of department wise is K 45,000 and all this they have told. Closing stock of department M includes 5,700 goods transferred from department K. Only closing stock reserve we are going to discuss. Other than that, you are just going to put it into the respective column, fill in the blanks. However, opening stock does not include any goods they are telling. Okay. Now, 5,700 is there in the closing stock of department M. If you go and check what is the closing stock of department M, closing stock of department M is 21,600. Out of 21,600, 5,700 received from other department K. Who made profit in this? Department K made the profit. How much profit? 30%. Go and check department K gross profit divided by sales into 100, 30%. So now if you multiply 30%, you will get 1710 as unrealized profit. Unrealized profit is 1710. P&L account debited to stock reserve. P&L account debited to stock reserve. Is this clear? Yes. With that, we are done with departmental accounts. Let's go next into insurance claim. The next chapter that I'm going to discuss is insurance claim. When we are talking about insurance claim, okay, there is life insurance, vehicle insurance, health insurance, marine insurance, transit insurance and fire insurance. But we are not considering any of that. We are only discussing about fire insurance. We are only talking about fire insurance. Now, fire insurance, when we are talking, there can be loss of stock. Loss of stock means what? We have stock that got destroyed by fire. We need to get a compensation now. Loss of assets, loss of people, loss of profit. Now, in this chapter, we are only covering loss of stock and loss of profit. Clear? Loss of stock. Loss of stock means what? I need to find out how much stock was there on the date of fire. Then I need to submit the claim to the insurance company. When I submit the claim to the insurance company will give me money. Clear? Now, first thing, prepare memorandum trading account from the date of previous year end till the date of fire. prepare memorandum trading account from the date of previous year until the date of fire. Why we are preparing memorandum trading account? Because if I prepare memorandum trading account till the date of fire, then I will know what is the closing stock on the date of fire. My job first is to find how much stock was there in the go down on the date of fire. I need to know how much stock was there in the go down on the date of fire. So first you prepare memorandum trading account. Now trading account will always have opening stock. Opening stock, what we are going to do last year end. Last year, previous year, what was the closing stock? That will be the opening stock. We start from there. Then purchases till the date of fire, whatever purchases are there, you are going to take that. Direct expenses, whatever is there till the date of fire, you are going to take that. And then sales. Okay, sales you are going to take till the date of fire, whatever sale is there, you are going to take that as well. Okay, then you are going to compute the gross profit. Then you are going to compute the gross profit. Okay, sales into gross profit percentage. Sales into gross profit percentage. Clear? When you get the gross profit, automatically the balancing figure will be the closing stock. When you get gross profit, the balancing figure will be closing stock. Now you have to understand one thing. Gross profit percentage, sir, if it is not given in the question, what to do? If it is not given in the question, gross profit percentage is not given, then prepare the trading account of last year. Prepare the trading account of previous year and find the gross profit percentage. That gross profit percentage will be taken as a gross profit for our calculation. Okay, so what we are supposed to do, understand this, prepare memorandum trading account. In memorandum trading account, what we will get, prepare memorandum trading account. In memorandum trading account, you will have opening stock, closing stock. Okay, everything should be there. Now, you prepare from what date to what date? When the year started till the date of fire. So, if you are preparing for this period, you will get the closing stock on the date of fire. Our job is to find the closing stock on the date of fire. This is your loss of stock. Okay. Next, we go into computation of loss of stock by fire. Now, you got the stock on the date of fire. Now, I know, sir, this much stock is there, sir, on the date of fire. But did everything get destroyed, sir, by fire? That we have to check. Computation of loss of stock by fire. Computation of loss of stock by fire. Closing stock on the date of fire. Take the closing stock on the date of fire minus stock salvaged. What is stock salvaged? Some stock might be saved. Okay, it did not get destroyed in fire. It might be saved. So minus stock which got saved. That is stock salvaged. Okay, minus savings if any. If any savings are there, subtract it. And then if any additional expenses we have incurred, add it. That time you will get the loss of stock by fire. Clear? Closing stock on the date of fire minus stock salvage. That means you saved this. Okay, good. Minus savings. We made more savings. Okay, good. Any additional expenses are there, add it like firefighting expense and all. That time you will get the loss of stock by fire. Now you have to compute the claim. Computation of claim. Okay. Computation of claim, always in insurance policies, there is one clause called as average clause. What does average clause tell? Only applicable when there is underinsurance. The average clause. Insurance companies don't like it if there is underinsurance. Underinsurance means what? You have goods of 1 crore, but you have taken insurance policy for only 60 lakhs. Insurance companies don't like it. Why they don't like it? Because for them it is a loss, no? You have this thing of 1 crore, but you have taken policy of only 60 lakhs. That means you are paying less premium. If you would have taken policy for entire amount, then you would have paid more premium. So insurance companies don't like it when you have underinsurance. So therefore, whenever there is underinsurance, average clause they have put. Average clause is applicable. Applicable only if there is underinsurance. Sir, how to check the underinsurance concept? Underinsurance is equal to insurance policy amount is less than the closing stock on the date of fire. Okay, closing stock on date of fire. Closing stock on date of fire is 120. Closing stock on the date of fire is 120. Okay, and the insurance policy amount is 100. Is there a problem? Yes. See, you have this much stock, but you took policy for only 100. That means this is called as underinsurance. That is called as underinsurance. That means policy amount is less than the closing stock on the date of fire. Closing stock on the date of fire. Clear? Now, if there is underinsurance, then average clause is applicable. If average clause is applicable, then you would apply this formula. Loss of stock by fire. Loss of stock by fire into policy amount divided by closing stock on the date of fire. Loss of stock by fire into policy amount divided by closing stock on the date of fire. Is this clear? So we are telling you had policy of only 100, but you had stock of 120. So in this proportion only, I will give you the claim for the loss as well. If there is no underinsurance is not there. We have taken proper insurance only. Then claim will be equal to loss or policy, whichever is less. Claim will be equal to loss or policy, whichever is less. This is the concept of loss of stock. Clear? Now we have to go into the concept of loss of profit. We have to go into the concept of loss of profit. Okay. In loss of profit, what we are going to do? Okay. Insurance company compensating for loss of profit. What is loss of profit? Insurance company compensating you for loss of profit during the period affected by fire. See, if at all there is a fire today, okay, next 2 months or next 3 months or next 4 months or next 5 months, you will be only thinking about how to bring your business back to normal. So that time your sales will get affected. If your sales are affected, your profit is affected. So that time what happens, if there is a situation like that, you will lose some profit. For that you have taken one insurance claim. I mean, you have taken one insurance policy. This is called as loss of profit policy. This is called as loss of profit policy. Clear? Here what we are going to do, step 1, computation of claim. First step is identify the period for claim. Identify the period for the claim. That means how much period is the period for which you can claim. Now understand, period which is affected by fire or indemnity period as per policy. In policy they have already fixed a period, no. You have taken a policy for a particular period, no. So if you have taken a policy for a particular period, that period or the affected period, whichever is less, that period or affected period, whichever is less will be considered as, okay, that will be considered for your first step. That is the period for which you can claim. That means, for example, by fire, I was affected for 6 months. But in the policy they told indemnity period is 5 months. Then I can get the claim only for 5 months. I was affected by fire for 6 months. In the policy, they told indemnity period is 8 months. So I can get claim for 6 months. Clear? Okay. Step 2. Once you know the period, go to step 2. Compute the gross profit percentage. Here the gross profit percentage calculation is different. Not like our loss of stock or other places. Here we are going to take net profit for previous year. Take last year's net profit. Add the insured standing charges. 100% this insured standing charges will be given in the question itself. Okay, add the insured standing charges, divide by the sales of the previous financial year, multiply into 100. Done, guys? Yes, guys. Can we go further, guys? Yes. Okay, net profit for previous year. Okay, take last year's net profit. They will give net profit of previous financial year, net profit of previous year plus insured standing charges divided by sales of the last financial year. Insured standing charges means expense going to be compensated by the insurance company. Insurance company will be like, see, you have too many expenses. I cannot give you money for everything. Okay. Insured standing charges means they are like, okay, this, out of all this, I will give you money. So these are the expenses I recognize. That is called as insured standing charges. Step 3, compute standard sales. Step 3, compute standard sales. Is this clear? Now, standard sales means what? Last year, same time. Understand this. Standard sales means last year, same time. Okay, sales during the previous year, during the same period of current year, which is affected by fire. Sales during the previous year, during the same period of current year, which is affected by fire. Take this example. If fire occurred on 1/7/2024 and affected period is 1/7/2024 to 39/2024, July, August, September, 3 months, then standard sales means last year, same time. Can you see 1/7/2023 to 39/2023? Okay, this is this year and last year, same time is going to be considered as standard sales. Is this clear? Yes. Now, step 4. Step 4. Compute short sales. Compute short sales. Last year, same time, I know how much I did. This year, during the fire affected period, I know how much I did. Difference is my short sales. Standard sales minus sales during the affected period. Last year I did something, this year I couldn't do that much. So difference what I couldn't do, that is called as short sales. Step 5, loss of profit. Okay, step 5, loss of profit. One second guys. Now loss of profit is short sales, whatever shortage you have which you just computed, short sales into gross profit percentage. Short sales into gross profit percentage will give you the loss of profit. Now step 6, additional expenses claim. Now insurance company will tell if you have extra expenses I will pay for that. Additional expenses claim, how to calculate actual additional expense, that will be given in the question. Actual additional expense will be given in the question. That is the first option. Next, gross profit percentage into additional sales due to additional expenses. They will tell if you could not, if at all you did not make this expense, your sale would be only 60,000. Now your sale is 1 lakh. That means extra 40,000 sale you made because of this additional expense. Okay, multiply the gross profit percentage on that. Gross profit percentage into additional sales due to additional expenses. Then third thing is, use the formula provided by insurance companies. Additional expenses into gross profit on annual turnover divided by gross profit on annual turnover plus uninsured standing charges. Additional expenses into gross profit on annual turnover divided by gross profit on annual turnover plus uninsured standing charges. Gross profit on annual turnover. Gross profit on annual turnover is last 12 months sales. Today fire happened, before this 12 months whatever sales are there, on that you calculate the gross profit. Today fire happened, before this 12 months whatever sales we have made, that is called as gross profit on annual turnover. On that gross profit you calculate gross profit on annual turnover. Is this clear? So additional expense, how you are going to take? First, actual additional expense or gross profit on additional sales due to additional expense. Third one, additional expenses into gross profit on annual turnover, whichever is less. Whichever is less. Is this clear? Okay. Next, we are going to go into the next thing. Okay. That is finally we are going to calculate total claim. Total claim. What profit you lost. Step 5 we calculated loss of profit plus additional expenses minus any savings. If you make any savings, minus it. This will be your total claim. Whether we will get it or not, different, but that is our claim. Note, if there is a trend, standard turnover and annual turnover must be adjusted for the trend. Trend means what? Sir, last year we were making some sales, sir. This year market was better. Actually, we should have made 10% more sales. So whenever we are taking last year's sales as comparison in standard sales, in annual sales and all, okay, when we are taking last year as comparison, what you are going to do is, you are going to increase it for the trend. Trend you are going to increase it. Okay. And annual turnover must be adjusted for the trend. Annual turnover must be adjusted for the trend. Clear? Now, under insurance. If there is under insurance, again same concept. Average clause will be applicable. What is under insurance? Here, what are we claiming? Profit. So, policy amount if it is less than gross profit on annual turnover. Policy amount, if it is less than the gross profit on annual turnover, it becomes under insurance, and if there is under insurance, the claim will be like this. If there is under insurance, the claim will be like this. Claim is equal to total loss into policy amount divided by gross profit on annual turnover. Total loss into policy amount divided by gross profit on annual turnover. Is this clear? This is your formula for claim. Okay. That should be it. Next chapter is hire purchase. Now we'll go into the problems. We'll discuss 3 examination problems. Every exam they are asking insurance claim 1 question at least. Okay. 11th question from our material, December 2024, 7 marks. On 10th December 2024, a fire occurred in the premises of Chandu. All stock except to the extent of 28,800 were destroyed. All stock except to the extent of 28,800 means what? This 28,800 which is there, this is salvage. Chandu values the stock at cost less 10%. Chandu always reduces the cost and shows the stock. Stock was insured for 1 lakh. From the following information, ascertain the amount of claim to be lodged by Chandu. Anywhere in the question, did they give you gross profit percentage? No. So what should we do? First thing, we should always calculate when we don't have gross profit percentage. Can you observe the question? No gross profit percentage is there. Okay. Gross profit percentage is not there. So we should calculate the gross profit percentage by preparing last year's trading account. Okay. So fire occurred on 10th December 2024. Okay. But our year started on 1st April 2024. So from this date to this date, we need to know what has happened. But first we'll prepare last year. Stock on 1st April 2023. Stock on 1st April 2023. 1,60,000. Oh, sir, here 1,44,000. Remember they told they are reducing the stock by 10%. We don't want to reduce and show. Accounting, maybe they are doing like that. But what we are going to do, we are going to take the stock at cost because we need to know exactly how much did we lose. So 1,44,000 is 90. How much is 100? Get the cost. It is 1,60,000. Then purchases during 23-24. Take the purchases 5,60,000. Sales during 23-24. 8 lakh. Take the sales 8 lakh. Okay. Then stock on 31st March 2024. Last year's closing stock. Take the stock as 1 lakh. How? 90,000 is 90%. How much is 100%? That time you will get gross profit as the balancing figure itself. Then what you will do? Gross profit divided by sales into 100. You're getting 22.5% as the gross profit. 22.5% is our gross profit. Clear? Now what you're going to do? Prepare memorandum trading account. Last year's closing stock will be this year's opening stock. Last year's closing stock will be this year's opening stock. Then they have told purchase less returns from 1st April. Starting of the year till the date of fire, they have made 5,84,000 purchases. Take that as purchases. Then they have told they have made 6,40,000 of sales. Take that as sales. Now what we are going to do? We know the gross profit percentage. Sales into gross profit percentage, you will get the gross profit. Sales into gross profit percentage, you will get the gross profit. Now closing stock is the balancing figure. This is the closing stock on the date of fire. This is the closing stock on the date of fire. Is this clear? Now when we know the closing stock on the date of fire, we are supposed to calculate the claim. Okay. Closing stock on the date of fire we know, but what was the actual loss of stock? Loss of stock is closing stock on the date of fire minus stock salvage. That time you will get the loss of stock by fire. When you know the loss of stock by fire, can you see closing stock on the date of fire is 1,88,000, but the policy amount was only 1 lakh. That means there is under insurance. Because there is under insurance, apply the formula loss of stock by fire 1,59,200 into policy amount divided by closing stock on the date of fire. This will be your claim. This will be your claim. This much claim you are going to get. Is this clear? Yes. Let's go into the next question. In June 2024 also they asked a 7-mark question. Now, from the following information, ascertain the consequential loss claim. That means here they are asking loss of profit. Here they are asking loss of profit. Now for loss of profit, I had told you specifically there are some steps we are going to follow. Okay, we'll keep the steps open and we'll go through those steps and we will try to solve that particular question. Okay, now financial year ends on 31st March with sales of 25 lakhs. Okay, their financial year is ending on 31st March and their sale is around 25 lakhs. Date of fire 1st September. Date of fire is 1st September. Period of interruption 1st September to 1st March next year. Indemnity period is 6 months. Okay, indemnity period is 6 months. What was our step 1? Step 1 was, okay, see the step 1 over here. Step 1 was identify the period for the claim. Now look at this. 19212, that means September, October, November, December, January. 5 months. We are affected by 5 months. But in the policy they told 6 months. So if we are affected for 5 months, policy has 6 months, then we can cover for 5 months. We can claim for 5 months. Clear? That was your step 1. Now, net profit 2,75,000 plus insured standing charges 3 lakhs. Net profit they have given of last financial year plus insured standing charges. What was the second step? Compute gross profit percentage. How will you compute gross profit percentage? Net profit of previous year plus insured standing charges divided by sales. Now you can see over here, net profit is 2,75,000. plus insured standing charges, they have given 3 lakhs divided by sales. Okay, we have to find the sales of last financial year. Can you see first sentence only they said financial year ends with the sale of 25 lakhs. So divide by 25 lakhs, you will get gross profit percentage of 23%. Go to the end of the question. They said increase in turnover 10%, trend, increase in turnover 10%, increase in rate of gross profit 2%. When you calculated this, you got 23%. But they said this year generally there is an increase of 2% in gross profit. At that 2%, your gross profit rate is 25%. Your gross profit rate is 25%. This is your step 2. This is your step 2. Now, step 3. What is your step 3? Compute standard sales. Compute standard sales. That means last year, same time. Uninsured standing charges is given. Sum insured is given. The policy amount. This is the policy amount. Sum insured. Okay. Standard turnover for corresponding months. 1st September to 1st March in the year preceding the fire. Last year, they have given last year same time. That is 7,50,000. But remember, if there is a trend, we should increase the standard sales. So 7,50,000 plus 10%, standard sales will be taken as 8,25,000. Standard sale is 8,25,000. Remember the next step. Next step is to compute. Next step is to compute short sales. What is short sales now? Standard sales minus sales during the affected period. How much did we make standard sale? We made a standard sale of 8,25,000. We just calculated it. Now we have to find out what is the sales during the affected period. Turnover in the period of interruption. Turnover in the period of interruption, we made only 225. So our standard sale should have been 8,25,000 if there is no fire. But because of fire, we made a sale of only 2,25,000. So 6 lakhs is your short sales or shortage in sales. Okay. Next step, you can see over here, step 5, loss of profit. Whatever shortage into profit percentage. So here we can check this. Our short sales is how much? 6 lakhs. 25% is our gross profit percentage, which we already calculated and kept. So short loss of profit is 1,50,000. Loss of profit is 1,50,000. Now let's continue. Annual turnover is given last 12 months sale is given 28 lakhs. Incurred additional expense of 50,000. Now additional expense claim we have to do and savings is 14,000. Reduced turnover avoided due to additional expenses. They are telling because of additional expenses, I made 1,50,000 more sale. Otherwise, I would make 1,50,000 less sale. Okay. Remember additional expenses when we are calculating 3 steps. 1, actual additional expense. What is the actual additional expense? Actual additional expense they said is 50,000. So first step we will take it as 50,000. What is second step? Second step they said gross profit percentage into additional sales due to additional expenses. Additional sales due to additional expenses. Apply the gross profit percentage. How much sales extra they made because of additional sales? How much sales extra they made because of additional expenses? 1,50,000. So our next step is going to be 25% into 1,50,000, 37,500. Second step. Third step they told us to do additional expenses into gross profit on annual turnover divided by gross profit on annual turnover plus uninsured standing charges. Now, understand this. Annual turnover we know, which is given in the question as 28 lakhs. But I told you, whenever there is a trend, you should adjust the standard turnover and annual turnover. At 10%, you get the annual turnover as 30,80,000. Okay. Calculate gross profit on that. You get gross profit as 7,70,000. This is your gross profit on annual turnover. Use the formula additional expenses into gross profit on annual turnover divided by gross profit on annual turnover plus uninsured standing charges. Sir, from where did we get, sir, uninsured standing charges? Sir, here only it's given uninsured standing charges is 50,000. Take 50,000. Now you get a value, whichever is less. Which is less in this? Here we are telling 50,000. Here we are telling 37,500. Here we are telling 46,951. That means this 37,500 is going to be the additional expense. This 37,500 is going to be the additional expense. Is this clear? Yes. Now what we are going to do? Okay. Have a look at this. Step 7 is your total claim. Okay, step 7, we have discussed step 7. What we are going to do? Loss of profit plus additional expenses minus savings. Okay, so here loss of profit is 1,50,000, which we calculated in step 6. Step 5, can you see here? Plus additional expenses 37,500, which we calculated in step 6. 37,500. Savings is given in the question only. We have a saving of 14,000. So minus 14,000 you'll get. This is your loss of profit. How much was your gross profit on annual turnover? 770. Gross profit on annual turnover was 770, but your policy is only 6,16,000. That means you have taken a policy for lesser amount. That makes it under insurance. When under insurance is there, you have to use the formula claim is equal to loss of profit into policy amount divided by gross profit on annual turnover. You will get a claim of only 1,38,800. You see this working note also. Gross profit on annual turnover is 770. Policy amount is only 616. That means it is creating an under insurance. And that time you have to use the average clause formula. Clear? Next, we'll go into question number 13. December 2023, where they asked another 7-mark question. Okay. Okay, guys. Now, let's go into question number 13. 1st April 2023, stock of Mr. Hari Prasad was destroyed by fire. Very good. First day of the year, only fire. Okay, but sufficient records were saved from which the following particulars were ascertained. Stock at cost, 1st January. Starting of the year, stock at cost, 1st January, 1,47,000. Stock, 1st January, it was 1,47,000. Clear? Now, stock at cost 31st December 2022. Stock at cost 31st December 2022, 1,59,200. Now, when did the fire occur? 1st April 2023 is the incident of fire. So, we need to know what is the closing stock on this date. On this date, what is the closing stock? We need to find that. Purchases year ended 31st December 2022, 7,96,000. And sales for last year also is given. Purchase from the starting of the year till the date of fire. Sales from starting of the year till the date of fire. All this is given. Okay, 7-mark question. Okay, in valuing the stock of for the balance sheet date 31st December 2022, 4,600 had been written off on certain stock. 4,600 they have removed. Okay, we have to add it because we want to know the actual value, which was a poor selling line having a cost of 13,800. Portion of these goods was sold in March 2023 at a loss of 500 on the original cost of 6,900. What did we do? Portion of these goods we have sold this year. This is a very common adjustment in insurance claim. Okay, that is slow moving stock is there. We have reduced the value, then we will sell it at loss. Other than this, everything will sell it at profit. The remainder of the stock was now estimated to be worth of its original cost, subject to the above exception. I told you, see, except this above exception, gross profit had remained at a uniform rate throughout the year. Gross profit had remained at a uniform rate throughout the year. The value of stock salvaged was 11,600. The value of stock salvaged was 11,600. The policy was for 1 lakh and was subject to average clause. Work out the amount of claim for loss by fire. Now, loss of stock they are asking or loss of profit? Loss of stock. First of all, anywhere in the question they have not given us about gross profit percentage. So, first thing that we have to do is find the gross profit percentage. So, first what we will do, prepare the trading account for 2022, last year's trading account. Now, opening stock is given 1st January 2022, 1,47,000 directly. This was not reduced, take it directly. Then, purchases for last year is given 7,96,000, take it directly. We don't have any direct expenses. Stock on 31st December 2022, that is last year's closing stock, but last year's closing stock was reduced by 4,600. So what you will do, 1,59,200 plus 4,600. You are going to add it back and this is going to be your closing stock. Then you have sales. Last year's sales is 9,74,000. Take the sales as 9,74,000. You will get a balancing figure. That is your gross profit. Balancing figure is gross profit. Gross profit is 194,800. Clear? Now you got gross profit. Compute the ratio. You are getting gross profit ratio as 20%. Gross profit divided by sales into 100. Clear? Now you prepare the memorandum trading account from the date of fire. From the starting of the date till the date of fire. Last year's closing stock will be this year's opening stock. Opening stock is 1,63,800. What is the purchases till the date of fire? 3,24,000. Then what is the sales? 4,62,400. Then What you're going to do, compute the gross profit, but gross profit we can't compute directly. Directly we can't put 20%. You know why? Because some of the goods were sold at loss, everything else was sold at profit. So our total sale is 4,62,400. In this, we have something called as abnormal sales. Original cost is 6,900. It was sold at a loss of 500. That means sale was 6,400. Can you see abnormal sale is 6,400. Remaining everything is normal sale. From this, if you remove abnormal sale, remaining everything is normal sale. On normal sales 20%, this will be your normal profit. This is the normal profit. But in this one sale, we made a loss of 500. So net what we did, here loss, here profit. So the net is 90,700. Here the net is 90,700. Is this clear? So gross profit will be 90,700. Now the balancing figure is closing stock on the date of fire. Closing stock on the date of fire. From that you remove the stock salvage. They have given in the last line stock salvage. Remove that 11,600. That time you will get the loss of stock by fire. When you get loss of stock by fire, compute the claim. Do we have under insurance? Policy amount was 1 lakh. On the date of fire, the stock was how much? 1,16,100. That means we have more stock. That means it is under insurance. So what you are going to do? Loss by fire into policy amount divided by closing stock on the date of fire. You will get an average clause. After applying average clause, you will get a claim of 90,009. With this, we are done with insurance claim. We are next going to proceed into hire purchase. Guys, so let's go into the next chapter, that is hire purchase. Okay, the next topic we are going to discuss is hire purchase. Now in hire purchase, let's take this example. We have one person called as Rakesh who will be considered as hire purchaser, and there is one person called as Dinesh who will be considered as hire seller. Now option 1, what does he have? He wants this car. First option is he will buy the car. Second option is he will buy it on installments. He doesn't want both. Installment also he does not want. He just doesn't want to buy it also. Third option that he has it, buy it through hire purchase. Buy it through a mode called as hire purchase. Now what is the difference, sir, between installment and hire purchase? Because in installment also we have to pay periodic amount, and in hire purchase also we have to pay some periodic amount. Clear? Now in hire purchase, ownership transfers on payment of the last installment. In installment, ownership transfers at the beginning itself. That means if you go to Reliance Digital and you buy one laptop or something on installment, that day only you are the owner of the laptop, but you have to keep paying the installment amount. But if you buy that laptop on hire purchase system, that time you become the owner only on the last day. You become only on the last day. That means when you pay the last installment, you become the owner. Till then you are not the owner, but you are going to enjoy the asset. You are going to take all the benefits from that asset. So on non-payment of hire purchase, in case of hire purchase, if non-payment happens, hire seller has the right to take the asset back. Hire seller will come, just take the asset back and go. But here in installment, if you don't pay, the person who has sold to you cannot take the asset back from you. The asset can't be taken back. They can only file legal charges. Now, if I'm going to buy the asset today I would have paid some price. No, that price is called as cash price. The price that you will pay today is called as cash price. Now, cash price in the market today. Hire purchase price. If I'm going to pay late, do you think I'll get at the same rate? No, I have to pay extra. Cash price plus interest. Hire purchase price will be cash price plus interest. Now, down payment. What is down payment? Down payment is initial payment to be made by hire purchaser. Down payment is initial payment that has to be made by the hire purchaser, and hire purchase price will be down payment plus installment. Today I will pay something, future I will pay installment. Total amount of price plus I will pay interest. These are two ways to calculate your hire purchase price. Repayment schedule. Always we have to calculate or prepare this repayment schedule in hire purchase. Now what will happen here? Opening balance will be there. Opening balance is first cash price minus down payment. Cash price minus down payment. That time you will get your opening balance that you are supposed to pay. Installment will be either given in the question. If it is not given in the question, principal payment plus interest payment. Principal plus interest will give you the installment. Interest will be what? Whatever opening balance is there, on that apply the interest rate, you will get the interest amount. Principal amount will be installment amount, what you have paid. Imagine you have paid 100 rupees, 10 rupees was interest, that means 90 rupees is principal. Same way, 90 rupees plus 10 rupees, if you do, you will get the installment amount also. Closing balance is opening balance. Out of that, how much principal portion you have paid, that will be taken. Clear? This is your closing balance. Now, accounting in the books of hire purchaser. Now, you have to do the accounting in the books of hire purchaser. First, we will do in the books of hire purchaser, then we will look into hire seller. Okay, if you are doing in the books of hire purchaser, first method is cash price method. First method is cash price method. Other method is interest suspense method. Cash price method and interest suspense method. First, we will discuss the cash price method. Okay, cash price method, asset is taken on hire purchase. Asset is taken on hire purchase. What do you get? Asset. So, hire purchase asset account debited. Hire purchase asset account debited because asset comes in to hire seller. Why to hire seller? Because we have to make the payment. We have not made the payment yet. So, to hire seller, this will be at cash price. This will be at cash price. Next, down payment. When you are making the down payment, hire seller account debited because balance what you're supposed to pay reduces. Hire seller account debited to bank account. Hire seller account debited to bank account. Clear? Next, at the end of each year, what are you supposed to do at the end of each year? First, at the end of each year, you are supposed to calculate interest due. First thing you are supposed to calculate is interest due. Interest is an expense for you because you are paying late. So interest is an expense. Interest account debited to hire seller account. Interest account debited to hire seller account. Installment. Next thing is installment. Installment, what you are going to do? You are going to make the payment. So hire seller account debited to bank account. Asset is with you. You are going to use the asset. So you are going to calculate depreciation. You are going to calculate depreciation. So, depreciation account debited to hire purchase asset account. Depreciation account debited to hire purchase asset account. Now, transfer to P&L. Transfer to P&L. So, what should be the entry? P&L account debited. Depreciation is an expense. Interest is an expense. Both will be transferred to P&L. This is your method. Next, we move into a method called as interest suspense method. Next method we are going to discuss is a method which is called as interest suspense method. Interest suspense method. Hire purchase asset account debited. Okay, starting only full interest we are going to record, but interest has to be recorded on the basis of accrual concept. So we cannot record full interest because we have not accrued it. So here what happens, we will pass the entry interest suspense account debited. Hire purchase asset account debited. Interest suspense account debited to hire seller account. Hire purchase asset account debited. Interest suspense account debited to hire seller. Total interest you are going to put to an account called as hire interest suspense. Down payment entry is same. Hire seller account debited to bank. You are going to make the payment. Hire seller account debited, bank account credited. At the end of each year, interest due. Now what you will do? Last time what you did? You passed an entry. Interest account debited to hire seller. Now you are not going to do because this is already done. Hire seller is already credited for the interest. So interest account debited to interest suspense account. Interest account debited to interest suspense account. Okay, interest account debited to interest suspense account. Next we are going to have installment. Installment you are going to pay. Hire seller account debited to bank. Depreciation entry same. Depreciation account debited to hire purchase asset account. Transfer to P&L. Interest and depreciation both are transferred to P&L. Now we move into the books of hire seller. We move into the books of hire seller. Now, hire seller, first method is called as normal sale method. For hire seller, selling this asset on hire purchase is his business. Okay, hire purchaser account debited because hire purchaser has to give us money, so debited, so debtor. Okay, to hire purchase sale account. Hire purchaser account debited to hire purchase sale account. Next, we go into down payment. In down payment, what happens? Bank account debited to hire purchaser account. Bank account debited because we get money, hire purchaser is credited. At the end of each year, what we are going to do? Interest due. We have to get interest. So hire purchaser account debited to interest. Hire purchaser account debited to interest account. Now we are going to record the installment. What is the entry for installment? Bank account debited to hire purchaser account. Bank account debited to hire purchaser account. You are getting money. Transfer to P&L. Interest is an income. Interest account debited. You are transferring the interest to P&L. Next method is called as interest suspense method. Interest suspense method. Here what we are doing, same thing. We are recording full interest at the first starting only and putting it into a suspense account. So hire purchaser account debited to hire purchase sale for cash price and interest suspense for total interest. Down payment, same thing. You are getting money. Bank account debited to hire purchaser account. Bank account debited to hire purchaser account. At the end of each year, what you are going to do? Interest due. At the end of each year, interest due. Interest due, you will not write, last time you wrote hire purchaser account debited. Now you are going to write interest suspense account debited to interest account. Interest suspense to interest account. Next, installment. Bank account debited because you are getting money. Bank account debited to hire purchaser account. Bank account debited to hire purchaser account. Transfer to P&L. Transfer to P&L. Interest account debited to P&L account. Interest account debited to P&L account. It is an income. That's why it is transferred to P&L. Default in payment of installment. If you miss any payment of installment, the hire seller can do two things. One is complete repossession or partial repossession. Complete repossession or partial repossession. Complete repossession means all assets are taken back by the hire seller. All assets are taken back by the hire seller. Partial repossession means some assets are taken back by the hire seller. Complete repossession means what? I had 3 trucks. This fellow took all the 3 trucks and went. Partial repossession means what? I had 3 trucks. He took 2 trucks and told 1 truck you keep it. Okay. Asset value will be adjusted with the payable amount. If he is taking the asset back, asset value will be adjusted with the payable amount. But after adjustment, if there is any balance, that has to be paid. Profit or loss on repossession. How will you calculate? WDV on the date of repossession. On the date of repossession, we had an asset. What is the WDV of that asset? Okay, value adjusted. Whatever value they agree to adjust, that you are going to take. Then profit or loss. Then profit or loss. Okay, that will be a profit or loss. WDV on repossession is this much. They took it only at this much value. That means remaining is your profit or loss. That should be your hire purchase. Let's go into the questions. We have an 16th question where they asked for 7 marks just to compute interest and prepare machinery account for 3 years. Interest they told and prepare machinery account for 3 years. Let's go into that particular question. Question number 16. Huh? Yeah. Examination question. We'll have a look at it. Okay. Okay, in this there is no repossession, guys. Exam actually last 2 attempts they have asked simple question only. There is no repossession. We'll go to some question where there is repossession so that we get complete idea of things. I think it's better to go for question number 14. Yes, question number 14. Okay, repossession. We'll have a look at repossession so that everything gets covered in one place itself. On 1/1/2020, B&B Brothers brought 5 computers from Chirag Computers on hire purchase. They bought 5 computers from Chirag Computers on hire purchase. The cash price of each computer was 20,000. How many computers they bought? 5. So 5 into 20,000. The total cash price is 1 lakh. If you go to the end of the question, open necessary ledger accounts in the books of both the parties, they have said. So we have to prepare both the parties. Okay. Now B&B Brothers, this fellow is the hire purchaser, and Chirag Computers, this fellow is the hire seller. Now the vendor charges interest at 10% per annum. It was agreed that 30,000 each at the end of each year you're going to pay. You're going to pay 30,000 at the end of each year. Okay, now we have to prepare the repayment schedule. But before that, the buyer depreciates computer at 20% per annum on diminishing balance method. Okay, depreciation rate is 20% WDV. B and brothers paid cash down of 5,000 each and 2 installments. How many installments it was supposed to be? It was agreed that they'll pay 30,000 at the end of each year. Okay, he has paid only 2 installments but failed to pay the last installment. 3 installments it was, 2 he paid, the last one he did not pay. Okay, so now we have to take the asset back. Consequently, the computer trader repossessed 3 sets. He took back only 3 sets, leaving 2 sets with the buyer and adjusting the value of 3 sets against the amount due. The sets repossessed after taking the set back, okay, were valued at 30% depreciation. He told, no, I don't agree with your 20% depreciation rate. Okay, the assets were depreciated more. So I take at the rate of 30% depreciation. Okay, 30% depreciation. I am not agreeing with your 20% depreciation. Okay, so then he'll calculate separately. The sets repossessed were valued on the basis of 30% on WDV. The sets repossessed were sold by Chirag Computers for 30,000 after necessary repairs amounting to 5,000 on 30th June. So now first we have to prepare the repayment schedule. Repayment schedule for 3 years. 2 years we have made the payment. Last year we have not made the payment. 31st December 2020, 31st December 2021 and 31st December 2022. Now opening balance. What is the opening balance? 75,000. Okay. How did we get 75,000? 1 lakh was the cash price. Okay. But they have paid a down payment. How much down payment did they pay? Oh, sorry. Not 5 computers, right? 1 lakh. Where is the down payment information? Yeah, here it is. They have paid down payment of 20. The buyer depreciates. Sorry, where is it? Hire purchase. What are we missing here, guys? Okay, cash price of each computer was 20,000. It was agreed that 30,000 each at the end of each year. Okay, 30,000 each at the end of each year. Okay. See. Now, understand this. Okay, repayment schedule. Down payment amount is missing. Down payment is 25,000. Oh, here it is told. B and B brothers paid cash of 5,000 each. 5,000 each is 25,000. Yes, sorry. 25,000 is the down payment. So you get 1 lakh minus 25,000, 75,000 as your opening balance. Now, installment they told 30,000, 30,000, 30,000. 3 installments. Okay. Interest rate they told 10%. So 7,500 into 75,000 into 10%. That gives you 7,500. Out of 30,000, you have paid 7,500. So 30,000 minus 7,500 will give you 22,500 as the principal. And the closing balance is 75,000 minus 22,500. So your closing balance will be 52,500. This is your opening balance. Okay, again on this 52,500 you're going to calculate 10% interest. This will be 30,000 minus 5250 and this will be the opening balance minus 24,750. Last year, when we go to last year, no, straight away take the opening balance and put it into the principal column and difference you put into the interest column. This is your repayment schedule. They told you to prepare the ledger in books of both parties. Now first we will talk about B and Bros. Okay, in the books of B and Bros, hire purchase asset we have and Chirag Computers we have. First we are going to purchase the computer. When we are going to purchase the computer, hire purchase asset or computer account debited to Chirag Computers, asset account debited to hire seller. Then we are going to make the down payment. Then what we will write, Chirag Computers account debited to bank account. Then end of the year interest entry. Interest account debited to Chirag Computers. Interest was 7,500. Then you are going to make the installment. Chirag Computers account debited to bank account. Chirag Computers account debited to bank account. Now you have your balance carried down. Clear? Now you have the balance that is coming over here, 52,500. Next, what we are going to do? interest account debited to Chirag Computers 5250. Interest account debited to Chirag Computers 5250. Okay, then to bank account. Chirag Computers account debited to bank account. Then what we are going to do? The remaining will be balance carried on. 2 years, everything went smoothly. Here what will happen? You are going to just calculate depreciation at the rate of 20% WDV. Depreciation, you get the balance, carry the balance down. Depreciation, you get the balance, carry the balance down. Like that, 2 years are gone. Okay, now when we go to the third year, what is happening over here? When we go to third year, hire purchase asset. Okay, we have hire purchase asset which is going to be repossessed. So you got the balance over here. Okay, now you have to do the calculation of repossession. Okay, understand the working note. WDV on 31st of December 2022 for 3 sets. We have to calculate for 3 sets. What is the WDV over here right now? WDV is 64,000. But 64,000 is for how many sets? It is for 64,000 is for how many sets? It is for 5 sets. So what you are going to do? 64,000 minus 12,800. 12,800 is this year's depreciation because end of the year only it's going to be repossessed, right? So this year's depreciation 64,000 minus 12,800. So you will do 64,000 minus 12,800 into 3 divided by 5. 30,720 is the WDV. 30,720 is the WDV on the date of sale. WDV on the date of repossession. Okay, according to us. According to them, they are calculating 30% depreciation. So cost is 20,000 into 3 sets, 60,000. Take 30% depreciation for year 1. Take 30% depreciation for year 2. Then take 30% depreciation for year 3 as well. Now you get 20,580. They are ready to adjust only 20,580, but your book value is 30,720. So 10,140 is the loss. 10,140 is the loss. So what you are going to do now when 10,140 is the loss? First you adjust this amount. Adjust this amount, asset and this thing you adjust the amount. Go to the asset account, right? Okay. Higher seller account debited. Higher seller account is debited to asset account. Higher seller account debited to asset account. Adjusted. Now loss should be debited to P&L. So P&L account debited to asset account. Then finally whatever balance carried down is carried down. This is your balance carried down. This should be it. Balance carried down. What will happen in Chirag Computers ledger? After adjusting also there is something remaining. After adjusting also there is something remaining. This is to be paid. After adjusting also something is remaining. This is to be paid. Clear? Now, in the books of Chirag Computers, what will happen? The ledger will just look opposite. Only extra ledger that we have to prepare is repossessed stock account. Repossessed stock account. He got his stock back. And he got his stock back for 20,580. You will write stock account debited, repossessed stock account debited to B and Bros 20,580. Clear? Now what is going to happen? He is going to spend some more money on that. 5,000 rupees repair he is going to do. So repossessed stock account debited to bank account. Repossessed stock account debited to bank account 5,000. Then what is he going to do after that? He is going to sell it. He is going to sell it at what price? 30,000. He is going to sell it at 30,000. So you will pass the entry bank account debited to repossessed stock. After that you are getting a profit. Transfer that profit to P&L. With that we are done with our hire purchase. We are done with hire purchase. We should proceed further into the next topic, that is branch accounts. Okay, next thing that we have to discuss or I want to discuss is branch accounts. Okay guys, next let's go into the next topic, branch accounts. Okay, in branch accounts, let's continue with branch accounts. Now see over here, in branch accounts what happens? Imagine you're doing business over here. You want to start doing business over here, so you'll set up a branch over here. This is called as inland branch. You want to set up branch over here, this is called as inland branch. But imagine you set up branch over here. This becomes a foreign branch. This becomes a foreign branch. Now in branch accounts, we have two types of branches. One is called as inland and another one is foreign. Now if you are talking about inland branch, in inland branch itself, we have couple of types. That is dependent branch and independent branch. That is dependent branch and independent branch. In dependent branch or independent branch, what is the difference? In dependent branch, okay, all the decisions are taken by head office. Okay, branch is just there to sell the goods and collect the money and give it to the head office. In independent branch, branch takes decisions on their own. Okay, so branch, what they will do, they will maintain books also. Here the branch will not maintain books. So books of accounts are not maintained in dependent branch, and in independent branch books of accounts are maintained. Okay, goods are sent at cost or goods are sent at invoice price. Either the goods are sent at cost or goods are sent at invoice price. Okay, this is prepared by whom? This is prepared by whom? It is prepared by debtors method. It is prepared by whom? It is prepared by head office. It is prepared by head office. Now there are three methods over here: debtors method, stock and debtors method, trading and P&L method. Debtors method, stock and debtors method, and trading and P&L method. Is this clear? The three methods that we have: debtors method, stock and debtors method, and trading and P&L method. Now understand one thing. Why are we doing this? Why are we doing this? This is done to find the profit of the branch. Why are we doing this? This is done to find out the profit of the branch. Find out the profit of the branch. Now we have debtors method. When we are talking about debtors method, in debtors method, you have to understand, whenever you are following debtors method, remember one thing in your mind. Okay, in the books of head office, we are preparing this. And the main tip is record only transactions between head office and branch. Record only the transactions between head office and branch. Clear? First, goods sent by head office to branch. When goods are sent by head office to branch, what should be the entry? If it is at cost. If it's at invoice price, we will see later. If it is at cost, branch account debited because it is an expense for the branch. Okay, to goods sent to branch account. Branch account debited to goods sent to branch account. If you remember consignment, there we used to write consignment account debited to goods sent on consignment. Similar it is. Okay, goods returned by branch to head office. Goods are returned by the branch to head office. That time you will pass the entry: goods sent to branch account debited to branch account. Goods sent to branch account debited to branch account. Reversal: goods sent to branch by head office. Goods sent to branch by head office. If it is at invoice price, first what you will do, branch account debited to goods sent to branch, you will record it at invoice price. Then removal of loading effect you will do, you will reverse it. Goods sent to branch account debited to branch account, you will remove the profit. Goods sent to branch account debited to branch account, you will reverse the profit portion. Then goods returned by branch. Goods returned by branch. What will you do? Same thing. You will write goods sent to branch account debited to branch account. You will record it at invoice price. Then you will reverse it again. Branch account debited to goods sent to branch, the profit portion. So whenever goods are sent at invoice price, immediately you have to pass the opposite effect. Cash sales at branch. Sir, no entry. No entry. What, sir? Why, sir? Why, sir, no entry? Remember the tip. We have to record only transaction between head office and branch. Transaction between head office and branch only are going to be recorded. Cash sale is a transaction between branch and customer. That's why there is no entry. Credit sale is a transaction between branch and customer. That's why in debtors method there is no entry. Amount received from debtors. Debtors have received amount from whom? From customer. Branch has received the amount from whom? From customer. Again there is no entry. Bad debts. It's a transaction between branch and customer. Again there is no entry. Sales return is a transaction between customer and branch. Again there is no entry. Amount sent to branch. When they get the money, if they send the amount to branch, that time there is an entry. What should be the entry? Bank account debited to branch account. Bank account debited because money comes. Branch has given me the money, so branch account is credited. Expenses of branch paid by branch only. Branch expenses branch only paid. No entry because we are not involved. Expenses of branch paid by head office. If expenses of the branch is paid by head office, then branch account is debited to bank account. Branch account is debited to bank account. Now close the GSTB. GSTB is goods sent to branch. How will you close it? You will transfer it to trading account. Goods sent to branch account debited to trading account. Just like goods sent on consignment account is also transferred to trading account. Now closing stock. Two things can happen. If it is at cost, no problem. If the closing stock is at invoice price, then you have to create the stock reserve. Remember, we learned unrealized profit in departmental accounts. It's applicable over here also. It's applicable in consignment also. You're going to pass the entry branch account debited to stock reserve account. Branch account debited to stock reserve account. Branch account debited to stock reserve account. You are going to pass the entry. Clear, guys? Yes, guys. Okay. Now, opening stock, if it is at cost, no problem. Just put it over there. If it is at invoice price, then what we are going to do? Reversal of stock reserve. Opening stock, you have to reverse the stock reserve. Stock reserve account debited to branch account. Stock reserve account debited to branch account. Is this clear? Yes. Give me a second, guys. Now, stock and debtors method. Stock and debtors method. Now, the second method is stock and debtors method. There, in debtors method, I told you, the tip is you're going to record only the transaction between head office and branch. You're going to record only transactions between head office and branch. Therefore, here we are going to record all the transactions. Okay, in stock and debtors method, we will record all the transactions. Now, what are the transactions? Ledgers are maintained. In stock and debtors method, we will record all transactions and ledgers are maintained for it. Now, what ledgers are we going to maintain? Branch stock account, branch debtors account, branch cash account, branch expenses account, branch asset account, branch P&L account, branch adjustment account. Branch adjustment account is only when goods are sent at invoice price. If it is sent at invoice price, that time you will prepare branch adjustment account. Now, when goods are sent by head office to branch, everything will be recorded. The tip is everything will be recorded. In debtors method, we are going to record only transaction between head office and branch. Here we are going to record all the branch transactions, but who is going to record it? Head office. Goods sent by head office to branch. You're going to pass the entry branch stock account. Branch stock increases, so branch stock account debited to goods sent to branch. Goods returned by the branch to head office, so the branch stock decreases. Goods sent to branch account debited to branch stock account. Goods sent to branch account debited to branch stock account. Goods sent to branch by head office. Goods are sent by branch to head office. Okay, if it is at invoice price, goods sent to branch by head office. If it is at invoice price, you will pass the entry. Branch stock account will be debited at invoice price only. To goods sent to branch, this will be at cost. To branch adjustment account, you are going to put the profit portion. Branch adjustment account, you are going to put the profit portion. If goods are returned by the branch, then you are going to reverse this. Branch adjustment account will be debited for the profit portion. Goods sent to branch will be debited for the cost portion. And branch stock account will reduce by the invoice price. Clear? Invoice price. Cash sales at branch. If there are cash sales at branch, branch cash increases, branch stock decreases. So branch cash account debited to branch stock account. Credit sales at branch. If there are credit sales at branch, branch debtors increases and branch stock decreases. Branch debtors account debited to branch stock account. Amount received from debtors. If amount is received from debtors, branch cash increases and branch debtors decreases. So branch cash account debited to branch debtors. Branch cash account debited to branch debtors. Okay, bad debts or discount allowed. If there is bad debts or discount allowed, branch expenses increases and branch debtors decreases. So branch expenses account debited to branch debtors. Branch expenses account debited to branch debtors. Sales return. Sales return. If there is a sales return, then branch debtors decreases. Branch stock increases. So branch stock account debited to branch debtors. Amount sent by branch to head office. Amount is sent by branch to head office. If amount is sent by branch to head office, bank account debited to branch cash account. If amount is sent by branch to head office, bank account debited to branch cash account. So you're going to write bank account debited to branch cash account. Now, expenses of branch paid by branch itself. Expenses of branch paid by branch. Branch expenses account debited to branch cash account. Expenses of branch. If it is paid by head office, branch expenses account debited but head office paid. So to bank account. Close the goods sent to branch. Close the goods sent to branch. Goods into branch account debited to trading account. Goods into branch account debited to trading account. Now closing stock, if it is at cost, no problem. If it is at invoice price, the entry will be closing balance of branch adjustment will be at profit. Okay, closing balance of branch adjustment will be the profit. So understand this, branch stock account is there. Here opening stock is at invoice price. Then branch adjustment account. Balance brought down will be the profit portion. Profit. Here closing stock will be at invoice price. Here balance carried down will be the profit portion. It will be the profit portion. Is this clear? Yes. Now opening stock at cost, no problem. Invoice price, opening balance of branch adjustment account. Closing stock. Okay, sorry, closing. How will you close each and every ledger? Branch adjustment account, balance carried down will be there. Any profit will be transferred to branch P&L. Branch debtors account, balance carried down will be there. Okay, branch cash account, transfer the amount to head office. What, sir? Why should we transfer the amount to head office, sir? Because branch, understand this, why should we transfer the amount to head office? Branch cash cannot be kept because head office is controlling everything. It's a dependent branch. Bank account debited to branch cash account. Bank account debited to branch cash account. Branch asset account, balance carried down. Branch expenses account, expense should be transferred to P&L. You transfer it to branch P&L, and in branch P&L, transfer the profit or loss to the P&L. To the P&L means you have to transfer it to head office P&L. Branch adjustment account, you will have balance carried down. Goods sent to branch will be transferred to trading account. Next method is trading and P&L method. If they ask you to prepare trading and P&L, just prepare, the head office will prepare the trading and P&L account for the branch. As if branch only is preparing the trading and P&L, you are going to sit in the head office and you are going to prepare it. Independent branch. When we are going into independent branch, head office will record their transactions. In independent branch, who is going to record the transactions? Head office will record their transactions. Okay. Branch account. We will maintain one branch account just to tell that branch is a debtor because they have to give us money. Branch will record their transactions and branch will maintain one head office account because head office is a creditor for them. So head office will tell branch as a debtor and branch will tell head office as a creditor. It should show the same amount. When I'm telling debtor creditor, if I'm telling I have to pay you 100 rupees, you also have to tell that you have to get 100 rupees from me. We should be on the same page. So if there is a difference, that has to be rectified. So end of the year, what is going to happen? Head office will add all the branch records to its books. Okay, so what they will do? Branch trading account debited, branch P&L account debited to branch expenses. Branch income account debited to branch trading to branch P&L. Is this clear? So what they are doing, all the branch expenses, they are going to add to branch trading and branch P&L. All the incomes they are transferring to branch trading and branch P&L. What will branch do? Transfer all the records to head office. They're like, okay, done. I maintain books, take the books, you prepare your financial statement. Okay, they will close the books. So liability, they will remove. Income, they will remove. Asset, they will remove. And expense, they will remove. They will close their books and next year they will start their books fresh. Clear? Now, assets, branch assets and branch liabilities will be shown in the balance sheet by the head office. Now, imagine head office has one branch and head office has one more branch. If there are transactions between these two branches also, head office will not record the transactions. Okay, branches will not record the transaction as from one branch to another branch. Branch will record the transaction like this, as if it went through the head office. If I sent goods from branch 1 to branch 2, you have to pass the entry in branch 1 that you have sent the goods to head office. Head office will send the goods to branch 2 in books. Is this clear? Okay. Now foreign branch. What is foreign branch? That is branch which is not within the country where the head office is situated. Head office is situated in India, and if there is a branch in Nepal, then this Nepal branch will be called as Foreign branch. Nepal branch will be called as foreign branch. Is this clear? Yes. Now, home currency. Home currency. Currency of the country where head office is situated. Currency of the country where head office is situated. What is foreign currency? Any currency other than home currency. So if you have India over here and head office is situated over here, then for us the home currency is rupees. Any currency other than rupees will always be foreign currency. Spot rate. Spot rate means rate on the date of transaction. That means basically spot rate is current rate. Closing rate. What is closing rate? Rate on the balance sheet date. End of the year, what is the rate? That is closing rate. Starting of the year, what is the rate? That is opening rate. Opening rate will be the closing rate of last financial year. Last financial year's rate is opening rate. Average rate. Average rate is opening rate plus closing rate divided by 2. Average rate is opening rate plus closing rate divided by 2. Is this clear? Understood? Huh? Okay. Now, foreign branch. Foreign branch books are maintained in foreign currency. Branch will give the trial balance to head office. Trial balance will be in foreign currency. Now, head office has to convert it into home currency. Foreign branch, do you think someone is sitting in Spain, they will maintain books of accounts in rupees? No, they will maintain the books of accounts in their currency only, euro. Then they will prepare their trial balance in euro. They will give you the trial balance and now you will convert that trial balance from euro to your home currency, that is your rupees. Clear? Rules to convert. Now, you have to follow some rules to convert it. If actual rate is given, it is always actual rate. If you know exactly on the date of the transaction, this was the rate, sir, this rate only I should take. If you don't know, then go into the rules. If you don't know the actual rate, you might have purchased 100 times in the year, so you cannot keep track of all the rates. If you don't know, then you go into the rules. Balance sheet items. Balance sheet items. If it is monetary items, what is monetary items? Okay, monetary items are debtors, creditors, bills receivable, bills payable, loan given, loan taken, cash, bank. All these are monetary items. It will be at closing rate. It will be converted at closing rate. Non-monetary items will be converted at actual rate. If actual rate is not there, average rate. And stock will be converted at closing rate because you are calculating closing stock on the last day, no? So closing rate. Incomes and expenses will always be at actual rate or at average rate. Any difference is there in the conversion, debit or credit to P&L, the forex difference will be debited or credited to P&L. With that, we are done with the concepts of branch accounting. Now we will go into the questions of branch accounting. Okay, we'll go into the questions of branch accounting. Now, question number 14. December 2024, they have asked one 7-mark question. Adiraj Limited Noida started a branch in Surat on 1st April 2023 to which goods were sent at 20% above cost. Goods were sent at 20% above cost. The branch makes both credit and cash sales. Branch makes both credit and cash sales. It is a policy to meet branch expenses from branch cash and remit the balance money to head office. It is a policy to meet the branch expenses from branch cash and remit the balance money to head office. Balance money you are going to transfer to head office. The branch does not maintain double entry books of accounts and necessary accounts relating to the branch are maintained by head office. They are not maintaining books. That means completely dependent branch they are telling. Show Surat branch account in the books of Noida head office to determine the profit or loss. They are telling Surat branch account. That means branch account. One account they are telling. That means it is debtors method. It is debtors method. If they would tell maintain necessary ledger accounts, then it would have been stock and debtors method. It would have been stock and debtors method. Clear, guys? Yes. Now, cost of goods sent to Noida branch. Goods sent to Noida branch. So you're going to pass the entry branch account debited to goods sent to branch, but we are sending the goods always at 20% above cost. So you will add the 20%. Okay, you will add the 20% and you will show the goods at 60,000. You will show the goods at 60,000. Is this clear? Yes. Now, after that, okay, goods received by branch till 31st of March at invoice price. We sent how much? 60,000. But they received how much? Only 54,000. That means 6,000 will be considered as stock in transit. Still goods are going, but it is the closing stock for the branch only. No, we have already sent. It should be in the closing stock. Okay. Now, credit sales for the year 58,000. Remember, in debtors method, we do not take transactions other than transactions between head office and branch. Credit sales, we are not going to consider this transaction. Closing debtors. Go and put in the balance carried down. Debtors 20,800. Bad debts is a transaction between customer and the branch. We are not going to record that. Cash remitted to head office. They sent us money. We will pass the entry. Bank account debited to branch account. So here you are writing by bank 43,000. Cash in hand at the end of the year 2,000. End of the year they have 2,000. So you will write balance carried down cash 2,000. Next you have cash remitted by head office to branch during the year 3,000. Cash remitted by head office to branch during the year 3,000. So what are we going to do? Cash remitted by head office to branch. So we'll pass the entry for 3,000. Okay, head office sent, so branch account debited to bank account. Then closing stock of the branch at invoice price 6,000, but along with the 6,000, we have to add one more 6,000. Sir, what is the 6,000, sir? This is 60,000, which is goods sent, minus 54,000, which is goods received. 54,000 goods received. So this 12,000 will be the closing stock. This is goods in transit, that also will be added. Closing stock is at invoice price. So what we should do, immediately we have to remove the profit portion. 12,000 into 20 divided by 120. 20% was on costs, so on sales it will be 120. 20 divided by 120. So you will get 2,000 as the stock reserve. Now what you are going to do? Then they told expenses incurred at branch. That means they only have incurred it. When goods were sent at invoice price, I hope you remember, if you have to remove the profit immediately, whatever you get balancing figure, that is your profit, and that profit will be transferred to P&L. That profit will be transferred to P&L. Clear? Yes. Next we go into June 2024, 7-mark question. Always go to the end of the question to find out what they are asking. In this question they have asked, you are required to prepare branch stock account, branch debtors account, goods sent to branch account, branch expenses account, branch adjustment account, branch stock reserve account in the books of head office. Only that much they have asked. Question number 15. So all the ledgers are there. You should keep all the ledgers open. See, branch stock, branch adjustment, branch debtors, branch cash, branch expenses, branch P&L and stock reserve. All the ledgers you should keep open, and then you should start passing entries together. I mean, you should start posting the entries together. Clear, guys? Yes, guys. Okay, now understand this. Ranu Stores of Jaipur has a retail branch at Kota. The goods are invoiced to the branch at selling price, which is obtained by adding 50% cost price. So profit is 50% on cost. That means 50 by 150 on sales. All expenses are paid by head office. Particulars are below. Now one by one, as we read, we should solve. Now opening balance, stock at invoice price 1,20,000. So you will go and write to balance brought down 1,20,000. Because this is at invoice price, adjustment account should have the balance brought down. So see over here, 1,20,000 into 50 by 150. On invoice price 50 by 150, 40,000 is the opening balance. Next, debtors opening balance 43,200. Go to branch debtors and write to balance brought down 43,200. Goods sent to branch at invoice price. Goods sent to branch at invoice price. What is the entry? Branch stock account debited, yes. To goods sent to branch, only the cost. This will be at cost. And profit you have to put it to branch adjustment account. How will you find the profit? 18 lakh into 50 by 150, 6 lakhs. Okay, this is 12 lakhs. Now the 6 lakhs will be there in branch adjustment account also. Is this clear? Yes, very, very important. Goods returned by branch invoice price. When we are returning the goods, what we are going to do? By goods sent to branch, this should be only cost. By branch adjustment, this one is there. No, this entry over here, 24,000 into 50 by 150. So when you are putting when the stock is sent, stock will increase by the invoice price. Cost you put to the goods sent to branch, and the adjustment part, the profit you put into branch adjustment account. Okay guys, next, cash sales. What should be the entry for cash sale? Branch cash account debited to branch stock account. Go to branch cash account debited to branch stock account. Clear? Next, credit sales. Credit sale, what should be the entry? Branch debtors account debited to branch stock account. Clear? Next, you have goods returned by debtors. The entry should be branch stock account debited to branch debtors account. Branch debtors is credited. Then cash received from debtors. The entry should be branch cash account debited to branch debtors account. Next, you have discount allowed to debtors. Discount allowed is an expense. So branch expenses account debited to branch debtors. Next, bad debts. The entry will be branch expenses account debited to branch debtors. Is this clear? Yes. Next, branch expenses paid by head office. All this is going to be paid by head office. So 1,01,000 plus 19,200 plus 6,000. So total you have 1,26,200. This is the branch expenses paid by head office. So go to branch expenses and write branch expenses account debited to bank account. Clear? Next, balances at the end of the year. Stock is at invoice price 199,200. Go to branch stock account. You will find 199,200, but this is at invoice price. So you have to find the opposite effect of that. 199,200 into 50 divided by 150, you will get the profit portion. Next, what we are going to do? Debtors closing balance 88,800. Branch debtors 88,800 should be the balance carried down. 88,800. Okay, next, apart from that, we are done with the question. So now what we will do? See the branch stock. Everything is there. There is a difference over here. This is the balancing figure. Okay, shortage or deficit is there. Transfer that to branch P&L for 4,800. Now next you go to branch adjustment account. The profit which is there, this balancing figure, this is realized profit that will be transferred to branch P&L. 5,65,600. Then next, after that, branch debtors, we already have everything in that. Branch cash, what we are going to do? Nothing is going to be kept. They are going to send the money. To send the money, they have to pass the entry. Bank account debited to branch cash. This is the balancing figure. Bank account debited to branch cash. Branch expenses are transferred to branch P&L. Branch P&L account debited to branch expenses account. And this balance is transferred to head office P&L. This balance is transferred to P&L. That is the head office P&L. Now stock reserve, what we are going to do? On the opening stock, whatever profit is there, that is the stock reserve. Opening stock, what is the profit we have? 40,000. Okay, that will be transferred to P&L this year because that is realized profit. Closing stock, whatever profit we have, that is the unrealized profit, that will be removed from the P&L. We have learned the concept of unrealized profit or stock reserve. Clear? Those are the two questions from branch accounts that you need to know. December 2023, there is a 7-mark question. There again they have asked normal branch account only. They have asked. You should be able to handle this, no problem. Next, we go into lease accounts. Okay, lease accounts. Yes, we have one question which we have to see from December 2023 for 7 marks they have asked. Now, let's go into lease. What is a lease, guys? What is a lease? Lease is a long-term rental contract. Long-term. You take a house, you go and stay in a PG. Okay, you're going to go and stay in a PG. This is not a long-term rental contract. It is a short-term rental contract. So a long-term rental contract is considered as lease. In lease, we have two types of lease. Finance lease and operating lease. We have finance lease and operating lease. Now, finance lease, what happens? Now, understand this. Lessor is the person who gave the asset. Lessee is the person who took the asset. In finance lease, when substantial risk and reward of ownership, by being the owner, you will have some risk of the asset and you will also have some reward from that asset. Risk and reward of ownership are transferred to the lessee. risk and reward of ownership are transferred to the lessee. Okay. Now, at the end of the lease term, lessee becomes the owner. At the end of the lease term, what happened? Lessee becomes the owner. Lessee becomes the owner. Okay, at the end of the lease term, lessee has option to buy the asset. At the end of the lease term, lessee has option to buy the asset. First condition is what? If at the end of the lease term, lessee becomes the owner automatically, it becomes finance lease. At the end of the lease term, if lessee has option to buy the asset, that is also finance lease. Now, major portion of economic life is covered by the lease. Major portion. Imagine life of the asset is 8 years. 6 years it's given on lease. In that case, it is a finance lease. Present value of minimum lease payment. Present value of minimum lease payment. That means whatever minimum lease payment is there from the lessee's point of view, the present value of minimum lease payment is almost equal to the fair value of the asset. What you are going to pay in future, when you take present value of that, that is almost equal to the fair value of the asset. That is almost equal to the fair value of the asset. That is the market value of the asset. Asset is of specialized nature. Asset is of specialized nature. Is it clear? Now, finance lease. Let's go into the next thing, that is finance lease. Now, finance lease, when we are talking about, we have two parts, lessee and lessor. In finance lease, lessee and lessor are there. In any lease, there is lessee and lessor. But minimum lease payment, how to calculate? You have to be very careful. Minimum lease payment from lessee's point of view. Lessee, what and all he is going to give? He is going to pay the lease rent. And he told at the end of the thing, I want the asset. So, guaranteed residual value by the lessee. He agreed to give the lease payment and he agreed to give the guaranteed residual value. Both of them will be taken as minimum lease payment. For lessor, what will be the minimum lease payment? For lessor, lease rent. For lessor, what will be the minimum lease payment? Lease rent that is going to get plus guaranteed residual value which is going to get from the lessee, or if he is going to get guaranteed residual value from somebody else, all this will be taken as minimum lease payment. Clear? Now, what is this? We have Srihari and we have Vishalakshi. Two people are there. Imagine one person has given the asset on lease to the other person. Now here there are three houses that are given. One house, if the lessee tells I want, that is guaranteed residual value from the lessee. One more house, somebody else tells outside that I will take it after the lease is over. That is guaranteed residual value by others. This house nobody has guaranteed, but there is a residual value for that. That is called as unguaranteed residual value. Unguaranteed residual value. When we are going into accounting, accounting we have to do in the books of lessee and accounting we have to do in the books of lessor. Okay. Accounting has to be done in the books of lessee and accounting has to be done in the books of lessor. Asset account debited. Asset account is debited to lease account. Asset account is debited to lease account. Is this clear? What is happening over here? Asset account is debited to lease account. Why asset account is debited? Asset account is debited because asset comes in. Lease account is credited because lease is a liability. Asset account is debited because asset comes in and lease account is credited because lease is a liability. Now lessor, what will lessor do? Lessee account debited to asset account. Lessee account debited to asset account. Why lessee account is debited? Because lessee has to give the money. So receivable for this person and asset goes out. Now in this fellow's books, no, asset is recorded at, this entry is there, no, it will be recorded at fair value of the asset. It will be recorded at fair value of the asset or present value of minimum lease payment from lessee's point of view. It will be recorded at fair value of the asset or present value of minimum lease payment from lessee's point of view. You have to take the present value. Using the present value factors, you have to calculate the present value. If fair value is 10 lakh and present value is 9.9 lakh, then this entry will be passed for 9.9 lakhs. And in this fellow's books, how will you record it? It will be recorded at present value of gross investment. It will be recorded at present value of gross investment. Sir, what is gross investment, sir? Gross investment is basically what and all the lessee will get. What and all the lessor will get. Minimum lease payment from lessor's point of view. Minimum lease payment from lessor's point of view means what? Lease rent plus guaranteed residual value from lessee plus guaranteed residual value from others plus unguaranteed residual value plus unguaranteed residual value. All this is called as gross investment. When you take the present value of that, it becomes present value of gross investment and it should be recorded at that value. Okay, at the end of each year, what entries will be passed? Interest account debited to lease. Why interest account is debited? Because it is expense and it is payable liability. Here, lessee account debited to interest. Here it is receivable and it is income. Clear? And here what we are going to do, lease account debited to bank. Lease account debited to bank, again it is, okay, why lease account is debited? Because we have paid. So liability reduces and bank money reduces. Here bank money comes, so bank account debited and the asset is gone. Lease is, lessee has made the payment. Then depreciation account debited to asset. Depreciation is an expense. It will be recorded in the books of lessor because lessor is currently using the asset. And then interest account debited to P&L. Interest is an income, so it will be transferred to P&L income. And P&L account debited. Interest is an expense, so it will be debited to P&L. Okay, P&L account debited and depreciation and expense. Depreciation and income both are expenses, will be transferred to P&L. Sale and leaseback. We have a concept called as sale and leaseback. Now you have to understand what is a sale and leaseback. Sale and leaseback is I am selling the house, then taking that same house back on lease and then paying lease rent. I am selling the house, ownership is transferred, then taking it back on lease and then paying the lease rent. Why do we do this? Imagine urgent money is required, they sell the asset, but that asset is required for their business, so take that asset back on lease. Now, profit or loss on sale. Profit or loss on sale. When we have profit or loss on sale, understand this simple. You have to understand this full chart. Everything will be sorted for you on profit or loss on sale. Now understand this full chart. Okay. If it is finance lease, don't bother about anything. The profit or loss will be amortized over the lease term. Amortized means it will be spread across the lease term. Example, WDV is 50. You sold the asset for 80 and you took it back on finance lease. This profit of 30 is there. No, if the lease term is 3 years, every year 10 per year you will transfer the profit to P&L. If it was loss also 10 per year you will transfer the loss to P&L. Now, if the sale is done and the lease back is operating lease, if the lease back is operating lease, okay, and the sale value is equal to the fair value, you have sold at the market price only, at the fair value only, then no problem, recognize now. Recognize now means what? Okay, you sold at correct value only. Sale is 80, WDV is 50, fair value is 80. That means see, you have sold it at fair value. The profit 30, directly you credit it to P&L. Profit 30, directly you credit it to P&L. Sale value is less than the fair value. If the sale value is less than the fair value, recognize now again. Sale value you have sold less than the market price. Little negotiation is normal. They said recognize now. No, we don't have to worry about anything. Now sale value is 80. WDV is 50 only. Fair value is 90. See, market value was 90, but you sold it for 80. No problem. The profit that is there, 30 rupees profit you made. Recognize the profit now. If the sale value, now the third option is very, very important. If the sale value is greater than fair value, if the sale value is greater than fair value. Now what you have to do, when sale value is more than the fair value, you sold it at higher than market value, which is not normal. So that extra profit which you made, that will be taken as profit and it will be amortized over the lease term. The normal profit that you made, that will be recognized now. That means sale value minus fair value, the extra profit, amortize it. Fair value minus WDV, that is normal profit, recognize. Now see, if fair value is 80, you sold for 90. Can you see you made 10 rupees extra profit over here? 10 rupees extra profit. So 90 minus 80 will be amortized over the lease term. Amortized over the lease term. But 80 minus 50, this profit is normal profit. So basically 90 rupees you sold it. 50 rupees is the WDV. That means you have a profit of 40 rupees. 40 rupees is your profit. Out of that profit, they are telling 10 rupees is abnormal profit, amortize over the lease term. Okay. 80 minus 50, the 30 rupees profit is there. Now that you will credit it to P&L. That you will credit it to P&L. This should be your concept of lease. One examination question they have asked recently. We will have a look at that. Annual lease payment they have asked, and unearned finance income also they have asked. Okay, lease, question number 8. Examination question. Yes. Now, Lease Limited has initiated a lease for 4 years in respect of a vehicle costing 20 lakhs with an expected useful life of 5 years. Okay. Vehicle today's cost is 20 lakhs. Lease is for 5 years. The asset would revert back to the company under the lease agreement. Other information available in respect of the lease as under: unguaranteed residual value of the equipment after the expiry of the lease term is 2,50,000. UGRV they have given. The implicit rate of return is 10%. Annual payment have been determined in such a way that the present value of the lease payment plus the residual value is equal to the cost of the asset. Present value of lease payment plus the residual value is equal. They are like such a way we have planned that present value is equal to today's fair value. Asset in the hands of the Lease Limited. Annual lease payment. Annual lease payment. How are you going to calculate? Cost is 20 lakhs. Divide by the present value factor of annuity. That time you will get 6,30,940. This is your lease rent. With that lease rent, you calculate your table. In your table, you are getting this is the gross investment, what you are paying totally. But present value of that is only this much. The difference between the two is unearned finance income. Okay, unearned finance income. Divided, that time you will get the value. This should be your answer. Shouldn't be a problem. Next, we move into accounting standards. All the chapters are done. We move into accounting standards. Okay, students, let's go into the next topic, which is very important as well. That is the accounting standards. We'll try to discuss the accounting standards. First standard we have is in our syllabus AS1, disclosure of accounting policies. Disclosure of accounting policies. Okay, first, this standard doesn't tell us which accounting policy to follow. So what this standard is doing? This standard is not telling us which accounting policy we should follow. They are only telling, boss, whatever you do, no, disclose it. Whatever you do, just disclose whatever accounting policy you follow. Then, all significant accounting policies adopted in preparation and presentation of financial statement should be disclosed. That means whichever accounting policy you are following, you should just disclose it. That means show it at one place. Where is that one place, sir, where we are supposed to show? Notes to accounts. The disclosure of significant accounting policy should form part of financial statement. It should normally disclosed at one place. So all the significant accounting policies should be disclosed at one place, and that one place is called as notes to accounts. Now, fundamental accounting assumption. In AS1, we have something called as fundamental accounting assumptions. What are the fundamental accounting assumptions? First one is going concern. What is going concern, sir? Fundamental accounting assumptions means whenever we are preparing financial statement, these three are always supposed to be followed. First one is going concern. Going concern means business has no intention or indication to end. There is no intention that the business is going to end, or there is no indication that the business is going to end. Consistency means the accounting policies chosen must be applied consistently. That means whatever accounting policies you are choosing, you have to apply it consistently over a period of time. Okay. Accrual concept. Accrual concept means what? Transactions. Record the transaction as and when they happen. As and when they occur, or as and when they happen. So transactions will be recorded as and when they take place, and not when you get money or when you pay money. So always transactions will be recorded as and when they take place. Okay. Conditions about fundamental accounting assumption. There is an assumption about fundamental accounting assumption that it is assumed by the reader that it is always followed. So anyone reading the financial statement, they assume that these three things are always followed. If any of these three things are not followed, disclosure to be made if any fundamental accounting assumption is not followed. Clear? Selection of an accounting policy. Selection of an accounting policy. points to be considered in selecting an accounting policy. So what should we understand? Whenever we choose an accounting policy, these things we have to keep in mind. First one is substance over form. That means don't see the legal reality, see the truth. That means if there is a land, we have a land. Land belongs to your father. On that land, he allowed you to construct a building. And this building is owned by the son and you are going to use for business. So now don't tell that land belongs to father. So building also should belong to father, because the building is used by the son for his business. That will be taken as the that can be, you can calculate depreciation on that building. Or we have finished hire purchase chapter. In hire purchase chapter, what we used to do, the owner of the asset is hire seller only till the last installment is paid, but depreciation is calculated by the hire purchaser. Now, materiality, information that helps the reader in decision making. Now, materiality means what? Don't stuff all the information to the reader. Don't put everything on the reader's head. Only what is important for the reader for decision making, give that to the reader. Prudence. Prudence means always provide for foreseeable losses. Always provide for future losses, but do not provide for future profit. This is called as conservatism. Clear, guys? Yes. Next, we go into change in accounting policy. When can we change an accounting policy? Enterprise can change its accounting policy only when the following three conditions are fulfilled. First one is when it's required by a law or statute. That means some Companies Act or Income Tax Act or some statute, they are telling us that you are supposed to follow this or you are supposed to change this. Then you are forced to change it. No other option. Or for the purpose of compliance with an accounting standard. One accounting standard is telling that this is the accounting policy that you are supposed to follow. So obviously you are going to change that as well. Make appropriate presentation of financial statements. Okay. You are changing because you feel by changing your financial statement will show a better picture. Note. Such changes affects the financial statements of either current period or later years, but it should be disclosed in the current period. Now, whatever change you are making, it might affect today or it might affect you in future, but you are going to present it in the current period. Disclosure of change in accounting policy. Disclosure of changes in accounting policy. Now, material in current period. That means it is affecting current period and amount is ascertainable. You know the amount. Amount should be disclosed. How much it is impacting your financial statement. Amount is not ascertainable. If you don't know the amount, then facts should be disclosed that you are unable to quantify the effect. Okay, if you don't know the amount, facts should be disclosed. Not material in current period, but affects the future period. Does not affect the current period, but it will affect the future period. Fact of such change affecting the future period must be disclosed in the current period. Okay, it is not affecting today, but it is affecting you in future. Then you have to tell that it will affect in the future. You are telling the reader that today it's not affecting us, but it will affect us in future. This is your rough revision of, quick revision of AS1. Okay, next we go into AS10. AS10 is property, plant and equipment. AS10 is property, plant and equipment. Meaning of property, plant and equipment are tangible items. What are tangible items? That means those items which are physical substance. That means you can see them. Okay, held for use in production and supply of goods or services, administration purpose or rental to others. Okay, so PP should be tangible items which are used in production and supply of goods or services. That means what? Imagine that I have one machinery. You have one machinery, plant and machinery. If you are using this machinery for production, if you are using this machinery for producing goods, then it will be considered as PP. Or if you are using this machinery for supply of goods, that means you have one truck. This truck, what you are doing, you are using this truck to supply the goods. That will also be considered as property, plant and equipment. Or for administration purpose, you have a machinery which will monitor the attendance of all the employees. That will be considered as property, plant and equipment because it is used for administration purpose. You have a computer, you are not going to manufacture anything, but you are going to sit and pass journal entries in that. That will also be considered as for administration purpose and it will be considered as property, plant and equipment. Or rental to others. You have a machinery, you are just going to give it on rent to somebody. That will also be considered as your property, plant and equipment. Expected to be used for more than one accounting period. Okay guys, you are using it for production, administration and supply and all, fine. But if you are using it for less than 1 year, not asset. Because then you come across the concept of capital and revenue expenditure. If it is used for less than 1 year, it becomes revenue expenditure. So the asset should be used for more than one accounting period. Recognition of PPE. Now you're like, okay, we know, sir, what is PPE, sir? When should I recognize in the books, sir? Okay, PPE shall be recognized only if both the conditions are satisfied. You will recognize the PPE only if both the conditions are satisfied. First one, cost can be measured reliably. That means somebody gave you an asset for free. You are not going to record it. That means you should be able to measure the cost. If you are able to measure the cost, then it will be considered as property. You can recognize that property, plant and equipment. Okay, it is probable that future economic benefit will flow to the enterprise. Okay, you are recognizing it as asset, very good, but it should be probable that you should get future benefit from that asset. Future economic benefit will flow to the enterprise, then you are going to recognize the asset. So I have one building over here, I have spent money on that, but I am not sure if government will allow me to use that building for my business. Then I cannot take it as PPE because there is no probability that future economic benefit will flow to the enterprise. Future economic benefit will flow to the enterprise. Next, initial measurement of PPE. Initial measurement of PPE. How are you going to record the PPE is what is the question. How are you going to record the PPE? If it is a purchased PPE, all these things you have to add. Purchase price. Purchase price. I have spent some money on purchasing one asset. Okay, but I am Indian. So I have asked for some discount, trade discount, ignore cash discount. We have already discussed in chapter number 1. Trade discount you will reduce, cash discount is a separate thing. You will pass entry for that. Okay, trade discount. Plus non-refundable import duty and taxes. What is this non-refundable import duty and taxes? We have something in GST. We have studied something in GST called as ITC, input tax credit. So if you are spending some money and you are going to credit on, you are going to get a credit of that, then you don't take it as expense. If you are not going to get that tax refund, then you will take it as expense and you will add it to the cost of the PPE. Then transportation cost. Asset came, but you have to transport it from one place to your factory. So that is going to be the cost. Handling, loading, unloading cost. Machinery you have to remove from the truck and you have to keep it in one place. You need some workers who are going to unload it. That is also going to be taken as the cost of the PPE. Insurance on purchase. Insurance on purchase. Okay, when you are purchasing, it was being shipped in the sea, so you took marine insurance. That insurance also will be added to the cost of the PPE. Brokerage to buying agent. Somebody helped you buy this asset, so you paid one brokerage to that particular person. That will also be considered as the cost of the PPE. Basically, whatever is spent to bring that asset to the present location and condition, that will be considered as the cost of the PPE. Now, what if I construct the PPE? I only construct the building. Direct material, whatever material I have used. Direct labor, whoever workers have worked on constructing that PPE. Other direct cost, electricity and other things, whatever you have spent, that also will be taken as the cost of the PPE. Production overhead. Production overhead. For producing, we have other things, no? Okay, machinery, we have used depreciation of that machinery. All that will be considered as self-constructed assets cost. Clear? Architect or consultant's fees. We have hired one architect. We have to pay some fees to him. That will also be considered as, this thing. What is that? That will also be considered as the cost of the PPE. Site preparation cost. We had a land. We had to construct building in that. The land looked like this. So what did I do? I had to fill some mud and make the land level. So making the land level, that is site preparation cost, that also will be added to the cost of the PPE. Installation cost, everything is ready. Someone we are calling some technician to install it, that will also be considered as the cost of the PPE. Cost of trial run, after that is ready, we gave it to the customers for free for few days. That will also be considered as the cost of the PPE. Minus sale proceeds from units produced in trial run. During trial run, I was manufacturing chips. During trial run, I sold it for free. That will reduce my cost of the PPE. Plus present value of dismantling and decommissioning. 10 years later, I have to dismantle the machine. So today I will take the present value of that. 10 years later, I have to make the land proper and I have to give it back to the owner. That also will be taken as the cost of the PPE. Finally, any other directly attributable cost, that will also be considered as the cost of the PPE. Is that clear? Items ignored while calculating cost. Items which are ignored while calculating cost. These items are not directly related to the cost of the PP. That's why we usually ignore it. One, tax if credit is available. I paid the tax, but somebody is going to give the money back to me. If they're going to give the money back to me, that does not make sense for me to take that as the cost. That's why we are going to ignore it. Office and administration overhead. One of you is sitting in the office and passing journal entries when the house is getting, when the building is getting constructed. You don't have a direct impact on that. That's why it is considered indirect and it is ignored. Selling and distribution overhead. Machinery is getting machinery is getting manufactured. Someone is selling goods. That fellow does not have a direct impact on the construction or manufacture of the PPE. So we are going to ignore it. Abnormal loss is avoidable loss. Abnormal loss is avoidable loss. This loss could have been avoided. That's why we are going to not consider that as the cost of the PPE. But abnormal loss will go to P&L and it will be debited. Advertising cost for the new product. You constructed one new beautiful factory. Okay, one new beautiful factory you have constructed. Now this factory which you have constructed, what you have done, once the factory is constructed, you have called Virat Kohli. You have called Virat Kohli for inauguration. This is just marketing or this is just advertising. So this will not be considered as the cost of the PPE. Interest cost, unless it is allowed by AS 16. One more standard which we are going to study today is AS 16. AS 16 talks about borrowing cost. If they allow us to capitalize the cost, then it is allowed. Other than that, any other interest cost, we are not going to add it to the cost of the PPE. Relocation of staff cost. We took the staff from one factory and put them to another factory. That is not going to be considered as the cost of the PPE. Operating losses. You cannot tell, oh, I constructed one building. First year I have lost. That loss also I will add it to the cost of the building itself. No, it will be taken separately. Training of the staff cost. You have some staff. They don't know how to use the machine. You are going to train them first. That will not be taken as the cost of the PPE because the machine is already ready. You training does not have any direct impact on that machine. Inauguration cost, which we just discussed, will also be considered as advertisement only. It will not be taken as the cost of the PPE. Now, income during construction of PPE. Now, imagine you are constructing the PPE. Okay, you have some income. When you are constructing one building, there only waste cement and all, you sold it to one scrap dealer. That fellow gave you money. So if it is not directly attributable, directly not related to the construction of the PPE, transfer it to P&L. Directly attributable, reduce it from the cost of the PPE. It is directly related to the construction, reduce it from the cost of the PPE. Now, PPE acquired on deferred payment. Deferred payment means what? I have acquired the PPE and I am going to make the payment in installments. Okay, now deferred payment means payment beyond normal credit period. Normally they are going to give me 90 days time, but I told I want 2 years time. Recognition of PPE. PPE is recorded at normal purchase price, today's price. And whatever extra I am paying, that is going to be considered as interest. If normal purchase price is not given, present value of future cash flow. If you don't know the normal purchase price, you will take the present value of what you are going to pay in the future. Okay, interest. Total cash outflow minus normal purchase price. Interest to be transferred to P&L over the credit period. So can you see interest will be taken as expense and it will be debited to P&L. Now, PPE acquired exchange of asset. If you acquire a PPE in exchange of an asset. I didn't understand, sir. What is this, sir? Okay. Now, PPE acquired means what? I have one car. And there is one truck here. So I'm going to give this car and I'm going to take this truck. I'm going to give this car and I'm going to take this truck. Okay, transaction has commercial substance. Transaction has commercial substance. What does it mean? Now, see this. Note, has commercial substance means PP acquisition affects the cash flow of the entity. Has commercial substance means by exchanging the asset, the new asset which is going to come, it is going to give me more benefit. It is affecting the cash flow. Lacks commercial substance means PP acquisition doesn't affect the cash flow of the entity. Lacks commercial substance means what? By getting the new asset after exchanging, it is giving me the same benefit as before. If it is giving me the same benefit as before, this is called as no commercial substance. If it gives me any extra benefit, it is considered as has commercial substance. Now, if PP acquired, transaction has commercial substance. That means you're going to get some extra benefit. Now, the new asset which you're getting, now this truck, they are asking the truck which you're getting, it should be recorded at what value? See, fair value of asset given up. Fair value of this car. If I know the fair value means what? Today's correct market value between two knowledgeable parties. If I know the fair value of this car, then I will take this car. Okay, I will take the fair value of the car only as the value of the new asset which is coming. If I don't know that, fair value of the asset acquired, I will take the market value of this truck. I'll take the market value of this truck as the value which I should record it. If I don't know both, then carrying amount of the asset given up. The car has one WDV, no? The WDV of the car only will be the asset cost of, the price of the value at which the truck will be recorded. WDV of the car only will be taken. So first preference is what? Fair value of the asset given up. Second preference is what? Fair value of the asset acquired. That is also not there. Then you're going to take the WDV of the asset. WDV of the asset which is given up. Clear? Transaction lacks commercial substance. That is, by exchanging you're not getting any extra benefit. So what you're going to do in such case? Recognize PP acquired at carrying amount of asset given up. Recognize the PP acquired at the carrying amount of asset given up. That means what is the WDV of the old asset? This will be removed. Same value will be the value of the new asset. That means this goes and just a new asset comes in that picture. That's it. Okay, guys. Next, PP acquired, exchange of asset. You have to pass a journal entry. Now, PP acquired in exchange and cash is given. So now see, sir, if you have some old bike and all, no, you give old bike and you take new bike, you think you don't have to pay any money? You'll have to pay some differential amount. So if you are acquiring a new thing and you have to pay money, so what will happen? PP account debited, whatever above amount we have decided, this fair value or this fair value or this WDV, that amount plus cash given. Okay, what will be the PP amount plus you are paying cash? So the PP amount will go up and to cash account for the cash that you are paying, and to asset account, the asset which is going out. Profit or loss will go to P&L. Profit or loss will go to P&L. Is this clear? Now imagine the PP is acquired and cash is received. If PP is acquired and cash is received, you acquired one PP and you are getting cash, then PP account will be whatever the value of the PP is there minus cash. So 100 minus 10, you will take 90 as the PPE, and cash account you will take it as 10. To asset account, whatever asset is going out, you are going to remove that asset, carrying amount WDV, then profit or loss will go to P&L. Now depreciation of PPE. PPE has to be depreciated, right? Yes, sir. What is depreciation, sir? We have already studied, sir. But now you are studying from accounting standard point of view, sir. Okay, sir. Okay, PPE depreciation start. When will you start the depreciation? When the asset is ready for use. When the asset is ready for use, you will start the depreciation. Put to use is irrelevant. Put to use you have studied in taxation. There put to use. Here it is ready for use. When the asset is ready for use, you will start depreciation. Clear? Component wise depreciation. Component wise depreciation means what? Now you have one. Okay, you have one car. You have one car. Before, the full car used to be depreciated together. Now you are like, sir, engine has 10 years useful life, sir. Can I depreciate engine separately? Yes. Tire has 2 years useful life, sir. I will depreciate the tire separately. The body has 5 years depreciation, sir. I will a useful life, sir. So I will use the, I'll depreciate the body over 5 years. Is it possible? 100%. We can do that. Is it compulsory? No. If you want to do it, the facility is there in AS 10. They are allowing you to do it. Land always has no depreciation. Building has depreciation. End. When will the depreciation end? PP is sold. When it is sold over, no depreciation only till that day, or PP is held for sale, whichever is earlier. So, what does AS10 tell? Not only when you sell, you stop using it and you kept it aside telling that I want to sell it, that time only depreciation will stop. Is this clear? Now, methods of depreciation. Straight line method, WDV method, and units of production method. We already studied in chapter number 1 all these methods. Change in the method of depreciation. Prospective effect. You change the method, don't give the effect from the beginning of time, give the effect from today. Considered as change in accounting estimate. When you change the method, it is considered as change in accounting estimate. Is this clear? Component accounting. Component means part of the PPE with significant cost. I told you, engine is part of the PPE. Depreciation to be charged for each component. Now, is it clear, guys? Can we go further? Yes. Subsequent measurement of PP. Subsequent measurement of PP. How are we going to take it? Cost model. Either we should follow cost model. That means you are always going to recognize that cost. Or we can follow the revaluation model. Treatment for revaluation. If you do revaluation, what is the treatment? First time you are doing revaluation, increase in the asset, credit revaluation reserve. It was 100, it became 120. So you put 20 to revaluation reserve. Decrease in the asset, so it was 100, it became 90. So you put 10 to P&L, debit it to P&L. Increase credit revaluation reserve. Subsequent decrease, debit revaluation reserve and then debit P&L. Now you already, this became 120, no, from 120 in future if it is going to become 70. So decrease is 50. Already 20 is sitting in revaluation reserve. So debit 20 to revaluation reserve and 30 you debit it to P&L. 30 you debit it to P&L. Decrease, debit P&L. Decrease, what you are going to do? Debit P&L. Now see, understand this. I have decreased it to 90, right? I have decreased it to 90. In future, this becomes 130. That means increase of 40. In this 40, 10 I had already put to P&L that time. 10 you credit it to P&L and remaining extra 30 you put it to revaluation reserve. Subsequent increase, credit P&L and credit revaluation reserve. Revaluation to be made for the entire class of assets. Now I have 10 buildings. All 10 buildings should be revalued. I cannot tell 2 buildings I'll revalue and 8 buildings I will show it at cost. That is not allowed. Okay, but if buildings are getting revalued, but if you want to show machinery at cost, that is allowed. Clear? Yes. Now let's go into AS11, guys. Next, AS11, effect of changes in foreign exchange rates. Effect of changes in foreign exchange rates. Now here, this is a very important standard. Whenever foreign currency is involved, AS11 will come into picture. This AS is prescribed for various changes which occur due to foreign exchange transactions, which covers the following. 3 are there. 1 we have already covered in branch accounts. Part 1, accounting for foreign exchange transactions. Okay, we are going to cover the foreign exchange transactions. Part 2, converting financial statements of foreign operations. This was there in branch accounts. Then part 3, accounting for foreign exchange contracts, forward contracts. If you have some forward contracts, that time you are going to worry about AS11. We'll discuss what it is. Important terms. Reporting currency. Reporting currency means what? We are preparing the financial statement over here, currency over here. It is the currency of the country whose financial statements are reported. If it is in India, it is rupees. Foreign currency, any currency other than reporting currency, everything will be considered as foreign currency. Now, exchange rate. Exchange rate we are going to discuss. It is the rate at which two currencies are exchanged. It is the rate at which two currencies are exchanged. Okay, I have $1. I want to convert it into rupees. What is the rate? That is called as exchange rate. Forward rate. Forward rate means what? I will get dollar after 5 days. Okay, I want to sell the dollar that time. So I am fixing a rate with you today itself. That means 5 days later you have to give me this rate. This is called as a predetermined exchange rate for settlement at a future date. Clear? Closing rate. Closing rate we have already seen. Rate on the date of balance sheet. It is the rate as at the date of balance sheet. Monetary items. Monetary items means what? Items that can be expressed in terms of money. Exactly in terms of money. Monetary, money held, assets to be received or liabilities which are fixed and determinable. That means they can be expressed exactly in terms of money. Example, cash and bank balance, debtors, creditors, loan, etc. Cash and bank balance, debtors, creditors and loan, etc. This is called as monetary items. Next we go into non-monetary items. Items which are not monetary items are called as non-monetary items. For example, your fixed assets, inventory, investments, etc. Is this clear? Now, accounting for foreign currency transaction. Accounting for foreign currency transaction. What we are going to do? How are we going to account for the foreign currency transactions? Meaning, transaction in foreign currency. Whenever we have a foreign currency transaction, first you recognize the transaction. That is called as initial recognition. The transaction happened. You have to recognize it. Initial recognition in foreign currency is to be recorded in reporting currency in the books of accounts. Rate to be considered will be spot rate. That means today's rate, that is rate prevailing on the date of transaction. Initial recognition. Is this clear? So what are we going to do? Initial recognition. Okay, when we for example, I purchased one machinery. Purchased of plant and machinery, $100. So what I will do, I have to recognize this transaction. So I'll pass the entry plant and machinery account debited to creditor. Okay, $100. Now $100 today, what rate is there? I will convert it at that particular rate. Now subsequent measurement. Valuation as on the balance sheet date. There is a possibility that few currency transaction is still outstanding on the balance sheet date. Can you see, if I don't pay the creditor, creditor will be there on the balance sheet date. On balance sheet date, the rate might be something else. So I will change the rate. So if it is a monetary item which is there on the balance sheet date, apply closing rate and restate the amount. If it's a monetary rate, apply closing rate and restate the amount. If it's a non-monetary item, there are two types of non-monetary items. Items are always shown at cost only. That means they are taken at original rate only. Do not restate the value. If the items are carried at fair value, that means, for example, stock and all, it is carried at market value, cost or NRV, whichever is less, that time apply the closing rate and restate the amount. Okay, if items are carried at fair value, apply the closing rate and restate the amount. Is this clear, guys? Yes, these two things you have to understand. Treatment of exchange rate difference. What will you do if there is an exchange rate difference? Exchange difference will be always transferred to P&L. How will you have exchange rate difference? I purchased on one day, I am going to restate on the balance sheet date. Initial recognition and settlement. Initial recognition and balance sheet date. Then I purchased on one day, I am going to pay on one day. Initial recognition and settlement. Difference between balance sheet date and settlement. Clear? Let's assume. Okay, let's assume over here. I'm starting from here. Understand? Purchased a plant and machinery for $10,000. Purchased a plant and machinery for $10,000. Okay, on 1st July 2022. 1st July 2022. What will I pass entry? I will pass the entry plant and machinery account debited to creditor. I didn't pay the money. Creditor. So I will write $10,000 into 22. Sorry, $10,000. Let's assume that day rate was 80. $10,000 into 80. So 8 lakhs. $10,000 into 80, it is going to be 8 lakhs. Now, paid on 1/7/2023 and that day the rate was 85. Paid on 1/7/2023, that day the rate is 85. But after that, on 31st of March 2023, there is a balance sheet date. 31st of March 2023, there is a balance sheet date. On that day, what you are going to do? On 31st of March 2023, what are you going to do? How are you going to record? 31st of March 2023, how are you going to record this? Understand this. 31st of March 2023, you will see what is the rate on 31st of March 2023. 82. Let's say 82. Now here you have two items here. Plant and machinery is a non-monetary item which will always be shown at cost. Ignore it. Creditor is a monetary item. Now creditor value has to change. So what you will do, if the rate has gone up, we have to pay more to the creditor. If the rate has gone up, we have to pay more to the creditor. So we will pass an entry over here. P&L for forex difference. P&L for forex difference debited to creditor. P&L forex difference credited debited to creditor. So what is going to happen over here? 82 minus 80 into 10,000. 82 minus 80 into 10,000. So you are going to write 20,000. Increase the creditor by 20,000. And when are you going to pay? 1/7/2023. 1/7/2023 you are going to make the payment. If you are going to make the payment on 1/7/2023, you will write creditor account debited. But creditor account will be debited for what value? Till now you have recorded the creditor at 82 only. Creditor account will be debited for 82. $10,000 into 82. That will become 8,20,000. But you have to pay 85 today. So extra loss again. P&L forex loss or forex difference debited $10,000 into 85 minus 82. That will be 30,000 to bank account 8,50,000. To bank account 8,50,000. I hope it is clear. Can you see this is the initial recognition that we talk about in the standard? Recognize on that day what rate is there. On balance sheet date, if there is monetary item, restate the monetary item. Creditor is a monetary item, increase it, and then finally you settle it. On settle it, if you are paying extra again there is a loss. Now MCA, Ministry of Corporate Affairs, they have given a notification. If exchange difference arise on long-term foreign currency, monetary items which relate to acquisition of depreciable asset, the difference can be added or deducted from the cost of the asset. It's an option, not compulsory. So if you take a loan and you purchase the asset, the loan is a monetary item which will keep changing, no? So if there is an increase in the loan, that's a loss. Loss can be debited to the asset itself. Or if there is a decrease in the loan because of foreign currency, that is a profit. That profit can be credited to the asset. Instead of putting it to P&L, you can increase or decrease the asset itself. That is what they have told. Forward exchange contract. Forward exchange contract means what? I know I will get dollars after 1 year or after 6 months. But after 6 months, I don't know what this market will be like. So to protect myself, done due to fluctuation risk or exchange rate. If I have done something, entered into a contract just to protect my risk, that is called as hedging. That is called as hedging. This is a process to reduce the loss. Now I don't want to take too much risk. I will hedge it. Okay, spot rate minus forward rate. Today's rate minus forward rate. It can be a loss or it can be a profit. If it is a loss or profit, it should be amortized over the life of the contract. Over the life 6 months, it should be amortized over the life of the contract. On cancellation of the contract, profit or loss should be recognized. Imagine later you felt no need of this contract, I will go with the market itself. That time it will be loss or profit will be recognized that time. Speculation means what? I am not trying to protect my risk or something. What I am doing, I am becoming very smart. I am like, oh, I can do that and make profit. Then not a process to reduce the loss, attempt to make profit using the change in the rate in the market. Now, premium or discount on the contract is ignored. Now, speculation means if you make profit, record it. If you make loss, record it. On maturity of the contract, profit or loss to be ignored. Oh, sorry. Profit or loss to be recorded. Okay. When you get the money or when you make the profit, that time you record it. This is your AS11 quick revision. Clear, guys? Okay. Let's move into AS12. The next accounting standard that is there for you guys is AS12. Accounting for government grants. Accounting for government grants. Okay, what does government grant means? Government grant means what? Government is giving you money. Usually in general language we call this as subsidy. We call this as subsidy. Now, government grants are grants which government gives to certain entities who are eligible for it. Government grants means what? The grants which government is giving to certain entities who are eligible for it based on certain preconditions. Okay, based on certain preconditions. Okay, and apply for it. They'll see government will give you money, but they will put some conditions. No, they will be like, if you do all these conditions, then the money is yours. Otherwise, I might come and ask the money back from you. Okay, non-applicability, government assistance other than government grants. Government is telling 5 years for you there is no tax. That is called as tax holiday. This is government giving you assistance. That government is not giving you money, government is giving assistance. This is not applicable. Clear? Government participation in the ownership. Government is giving you money and telling, I am also the owner now, give me shares. This leads into a territory called as government company. We are not going to discuss that. Here it is going to be government participation is not there. If government gives you money and becomes owner, then we are not going to discuss that particular thing over here. Types of government grant and recognize. How to recognize the government grants? Understand this. Bailout grant. Bailout grant means what? You are in trouble. Government is giving money to pull you out of trouble. You are in trouble. Government is giving you money to pull you out of trouble. This is called as bailout grant. Now, here what we are going to do? Grant given to companies who are under loss. Grant is given to companies who are under loss. So now bank account debited because you are receiving the money to P&L account. Bank account debited to P&L account. Income grant. Income grant means what? You have done something good. Government is giving you money as a reward. Okay, in the nature of reward in any kind of business. Bank account debited to P&L account. They are giving you money. Clear? Expense grant. Government is giving you money, telling that this money should be used for expense only to meet the specific expenses. Until government grant is not used, show it as liability. Okay. Government gave you 10 rupees and told, use it for paying salary, only for paying salary. Now what will you do? When you get the money, you will write bank account debited to deferred government grant 10. To deferred government grant 10. That means you are showing this as a liability because it is not spent yet. Now when you spend the money for salary, you will pass the entry salary account debited 10 to bank 10. Salary account debited 10 to bank account 10. You will pass the entry that time. Then what you will do? Salary account debited to bank 10 rupees. Then what you are going to do is, okay, now we have utilized the money. No. So you will pass the entry deferred government grant debited 10 to P&L 10 and P&L debited 10 to salary 10. Salary is an expense, it will go to P&L, but deferred government grant went to P&L as income. So can you see income and expense? This will get cancelled with each other because somebody gave you money for paying that. Okay, so when you get the money, you cannot put it to P&L. When you get the money, you keep it as liability. When you spend the money, that expense will go to P&L. That time this also you transfer to P&L. Next, when used, reverse the liability, show it as income in the P&L. Okay, non-monetary grant, asset received free of cost. Somebody gave you one building, government is giving. Government gave you one building or government gave you one machinery for free of cost. Okay, for free government gave you machinery. It is to be recorded at nominal value of 1, 10 or 100. It is to be recorded at nominal value of 1, 10 or 100. Asset account debited to capital reserve. Asset account debited to capital reserve. Is this clear? Okay, next. Sir, why sir? We didn't pay even 1 rupee. No, sir, why are we recording it? See, we are using the machinery. No, we are using the asset. No, just to tell that we have the asset at a nominal figure of 1 rupee or 10 rupee or 100 rupees, whatever you want, you take it and you show it in the books. Clear? Non-monetary grant, asset received at concessional rate. Okay, 1000 rupees is the cost of the, 1 lakh is the cost of the asset. Government gave it to you for 10,000. Now, should you record the asset at 10,000 or at 10,000 or 1 lakh rupees? You will show it at acquisition price, that is 10,000. You will show it at acquisition price, that is 10,000. Grant received as promoter's contribution. What is promoter's contribution? Promoter's contribution means government is telling you start the business, I will give you money. But I don't want ownership. If I take ownership, then that is not AS12. Government is telling you start the business, I will give you money. Okay, that money which they are giving, it will be credited to capital reserve. The money that they are giving, it will be credited to capital reserve. So you will pass the entry bank account debited to capital reserve. Clear? Now, grant for depreciable assets. Method 1. Depreciable asset. They gave you money to buy one depreciable asset. When you purchase the asset, okay, when you purchase the asset, what entry will you pass? You will pass the entry asset account debited to bank account. After that, you will go and submit the bill to the government and tell, see, I have spent so much money. Now, government will tell, okay, I will give you money. That time you will pass the entry bank account debited to asset account. When you purchase, asset value increases. When government gives you money, asset value decreases. Clear? Depreciation to be charged on the balance value. Whatever balance is there, you will charge depreciation. Method 2 we have, method 2, bank account debited to deferred government grant. That means you purchase the asset account debited to bank account. And when I get the government grant, I will not touch the asset at all. I will pass it to a separate account called as deferred government grant. And this deferred government grant will be amortized to the P&L over the life of the asset. So here if I get government grant of 50, I will directly reduce the asset only by 50. Here if I get government grant of 50, I will put it to a deferred government grant, and if the life of the asset is 5 years, every year 10 I will put to P&L, that 10 I will credit it to P&L. Is this clear? Now, what if I don't follow the rules, sir, and I have to refund the government grant, sir? If I don't follow the rules and I have to refund the government grant, I have to reverse the entry, correct? Now, to be treated as extraordinary item, it's an extraordinary item because you are expected to follow the rules that government is putting forward. So, it will be considered as an extraordinary item. Reversal of the above treatment in the case of refund. That means if P&L was credited, when you got the money, if P&L was credited, now P&L will be debited. If capital reserve was credited, when was capital reserve credited? When you got the money as promoter's contribution. Now debit it to capital reserve. Now debit it to capital reserve. If grant was deducted from the cost of the asset, now add it back to the cost of the asset. If grant was credited to deferred government grant, now reverse it to deferred government grant to the extent available. How much deferred government grant is there? Reverse it. Otherwise, put it to P&L. Treat it as an expense in the P&L. This is a quick revision of your AS 12. Next, we'll move into accounting standard 16, that is borrowing cost. Now, what is borrowing cost? Borrowing cost, sir, nothing, sir. Interest. Yes, it's one of the borrowing costs. Okay, borrowing costs are interest and other costs incurred by an enterprise in connection with the borrowing of funds. I borrowed money, I have to pay interest, that is borrowing cost. I borrowed money, that time there was processing charges, that is borrowing cost. I borrowed money, I decided to repay it early, that time there are some charges, that is borrowing cost. Now, rule of AS 16 is borrowing cost related to qualifying asset to be capitalized till the asset is ready for use. Borrowing cost related to qualifying asset. If there is anything related to qualifying asset, borrowing cost, see, borrowing cost is expense, right? It will always go to P&L, right? But if it is related to qualifying asset, it will be capitalized till the asset is ready for use. It will be capitalized till the asset is ready for use. Is this clear? Now, qualifying asset. Borrowing cost related to qualifying asset will be capitalized till the asset is ready for use. Now, what is qualifying asset? Simple, sir. Qualifying asset means something that takes time for it to be ready for its intended use. Something that takes time for it to be ready for its intended use is called as qualifying asset. An asset that necessarily takes substantial period of time to get ready for its intended use or sale. Borrowing costs are capitalized as a part of the qualifying asset when it is probable that they will result in future economic benefit to the enterprise. You took one loan and you're constructing one building. Building will take some time for it to be ready for its intended use. This is called as qualifying asset. Now you took one loan and you bought one AC. AC is already ready. It's not going to take more time. This is not a qualifying asset. You took one loan and you're going to manufacture a AC. That is going to be considered as a qualifying asset. And if at all there is borrowing cost, you will add it to the qualifying asset if that qualifying asset will give you future economic benefit. Imagine you took one loan and you're constructing one building, but the building will not be used for the business only, or government is not going to allow you to use that building for your business. Then it is not going to be considered as qualifying asset, and that borrowing cost will not be capitalized. Other borrowing costs are recognized as expense in the period in which they are incurred. Anything other than this, what we are going to talk in AS 16, no, always borrowing cost will be taken as expense in the P&L. Now, borrowing cost eligible for capitalization. Borrowing cost directly related to the acquisition, construction, production of qualifying asset, capitalized. Assets other than qualifying asset debited to P&L. You took one loan, okay, and you constructed one building. Till the building is ready, put the borrowing cost, capitalize the borrowing cost. You took one loan and you purchased one AC. AC is not a qualifying asset. Transfer the borrowing cost to P&L. Transfer the P&L and interest you debited to P&L. Commencement of capitalization. Sir, when should I start the capitalization? Loan should be there. Construction should be going on. Loan should be there. Construction should be going on. See this. Capitalization of borrowing cost as a part of the assets of a qualifying asset should commence when all the below conditions are satisfied. First condition, Expenditure for acquisition, construction and production of qualifying asset is being incurred. I told you, you took loan but you did not start the construction, no capitalizing. You took loan but you did not start the construction of the building, then it is not going to be capitalized. So expenditure for acquisition, construction or production should be in progress. That means you took the loan and the work is happening. Borrowing costs are being incurred. Work is happening but you did not take the loan only, then there is no concept of capitalizing. Work is happening, yes, but you did not take the loan itself, then you are not going to be talking about anything called as capitalizing. Activities that are necessary to prepare the assets for its intended use or sale are in progress. Imagine you took the loan, you started the construction, then there was a COVID lockdown. Now you stop the work, no. The work is not in progress, no. Then the interest will now go to P&L. You started the work again, now interest will be capitalized. Suspension of capitalization. The same thing what we were discussing, COVID lockdown, suspension of capitalization. If at all, okay, our work is suspended because of COVID lockdown. Example, that time your capitalization also will be suspended. You will stop. Temporarily you will stop. Clear? Now, when COVID lockdown, they said COVID lockdown. No, that time what you told? Okay, fine. Outside work I can't do. Inside work I'll do. Interior you started doing. That means still some work is going on. You will continue to capitalize the borrowing cost. That means whatever interest is incurred, you will add it to the cost of the building only. Now, sometimes what happens when you're constructing the building, maybe when you finish a slab, you have to stop for some days. You have to just keep putting water for a few days and you have to stop the work. Why you are going to stop the work? Because that is part of the process. If there is something like that, then fine. Stopping is part of the process, continue the capitalization. Stopping is not part of the process, stop the capitalization. But when stopping also some administrative work is going on, continue the capitalization. Now understand this. Borrowing costs may be incurred during an extended period in which activities necessary to prepare an asset for its intended use or sale are interrupted. Such cost of holding partially completed asset do not qualify for capitalization. Now, if our work is interrupted, borrowing cost will not be eligible for capitalization is what they are telling. Now, capitalization of borrowing cost is normally suspended. When will you not suspend? During a period when substantial technical and administrative work is being carried out. Work stopped, but still you are doing the technical and administrative work. That time the borrowing cost will continue. Or capitalization of borrowing cost is not to be suspended when a temporary delay is a necessary part of the process. If there is a temporary delay, it is a necessary part of the process of getting an asset ready for its intended use. So I stop because that is part of the process. I have to give some rest for 15 days. Okay. Cessation of capitalization. Cessation of capitalization means what? When will you permanently stop? When will you permanently stop capitalizing? When the asset is ready. Building is getting constructed, loan interest you are paying, keep putting the loan interest or keep adding the loan interest to the building. Building construction done, after that loan interest which is there, you have to debit it to P&L. Capitalization of borrowing cost should cease when substantially all the activities necessary to prepare the qualifying assets for its intended use or sale are completed. That means all activities are done, asset is ready for its intended use or sale. Type of borrowing. You have two types of borrowing. One is called as specific borrowing. You took the loan for this only. You took the loan for construction only. This is a borrowing which is made specifically for the purpose of manufacture or construction of qualifying asset. It should be capitalized other conditions if other conditions are satisfied. General borrowing. That means you took the money for business purpose. Little you are using for qualifying asset, little you are using for others. This borrowing is which is made for general purpose, one of which is a qualifying asset. Amount to be capitalized is expenditure on qualifying asset. How much did you spend on qualifying asset into weighted average rate of borrowing? What is this weighted average rate of borrowing? I have one loan from SBI, 5 lakh, 10% is the rate of interest. I have one loan from HDFC, 10 lakhs, 8% is the rate of interest. So what I will do now, 5 lakh into 10% is basically 50,000 and 10 lakh into 8% is equal to 80,000. So total interest is 1,30,000 and the total loan is 15 lakhs. So the weighted average rate will be 1,30,000 divided by 15 lakhs into 100. 1,30,000 divided by 15 lakhs into 100 will be 8.67%. So whatever amount out of the general borrowing, out of this 15 lakhs, whatever amount I have used for qualifying asset, I will apply the rate of 8.67% and I will capitalize that. Whatever amount I have not used for qualifying asset, that will go to P&L. Okay, weighted average rate of borrowing is total borrowing cost divided by total general borrowing. Balance borrowing cost to be debited to P&L. And with that, we finish our quick revision on AS 16. You have to go and practice questions, guys. Okay, to be thorough with it. The last accounting standard is AS 22, accounting for taxes on income. Okay. Now, this standard is applicable because of tax. If you know a little bit of tax, you'll be able to grasp this standard fast. This standard prescribes the accounting treatment for taxes on income and following the concept of matching expenses against revenue for a period. Now, this standard is applicable when there is a difference between accounts and tax. There are a lot of areas where in accounts we follow one rule, in taxation we follow some other rule. Okay, in accounts we take it as expense in 1 year, in taxation we take it as expense in 5 years. Across 5 years. So that time this comes into picture. There are two types of difference, timing difference and permanent difference. Timing difference means what? It will happen in accounts today, it will happen in taxation tomorrow, but it will happen. Both the places it will happen. Permanent difference means what? It will happen in accounts, but in taxation it is disallowed. They are not allowing only in taxation. Okay. Taxable income sometimes significantly differs from accounting income. As per books of accounts, what income you have, and as per PGBP or as per taxation, what income you are calculating, they are different. This difference from taxable income and accounting income arises due to following reasons. What are the reasons? Firstly, okay, there are differences between items of revenue and expense as appearing in the statement of P&L and items which are considered as revenue and expense, which are known as permanent difference. That means what? It will happen here, it will not happen there. It will happen there, it will not happen here. Clear? Secondly, there are differences between amount in respect of particular items of expense as recognized in the statement of P&L, corresponding of which is recognized in the, this is known as timing difference. For example, if I tell you, if you give donation to private trust, in tax it is disallowed. Tax it is disallowed, but in accounts you can take it as donation expense. Clear? Or if you make cash payment, okay, more than 10,000 in a day, that time it is disallowed. If you make cash payment of more than 10,000 in a day, that time it is disallowed. Now, what happens in accounts? You pay cash payment of 1 lakh also, you will take it as expense in your P&L, but in taxation it is disallowed. In taxation it is disallowed. So these are the examples for permanent difference. What are timing difference? Timing difference. Okay, one of them is depreciation. Here you follow SLM, in taxation you follow WDV. Another timing difference is preliminary expenses. Preliminary expenses. Here you take it preliminary expense in 1 year only. In taxation as per section 35D, you are supposed to take it over 5 years. Then you have the expenses which are there in 43B. What is 43B? There they are telling if you pay the expense within the due date for filing the return of income, we will allow you to take it as expense. Otherwise, we will allow it in the next year. But in accounts, we follow accrual concept. If you don't pay 1 rupee also, we'll still take it as expense. Clear? Definitions. Accounting income or loss. This is what is there in your P&L. Okay, net profit or loss as reported in the P&L before deducting income tax expense. Taxable income. This is what you are calculating as per tax loss. Income as per tax loss. Tax expense. Tax expense means when you're talking about tax expense, this is current tax plus or minus deferred tax. Current tax plus or minus deferred tax. Current tax means what? It is the amount of income tax determined to be payable as per income tax. As per income tax, what you got as tax payable, that is called as current tax. What is deferred tax? Deferred tax is the tax effect on the timing difference. Because of timing difference, what tax effect you have, that is called as deferred tax. Timing difference we already discussed. There is timing difference we already discussed. There is permanent difference as well as this thing. What is that? Reversible difference. Reversible difference is called as non-reversible difference is called as permanent difference. And other than which reverses is called as timing difference. Clear? Now recognition. Tax expense for a period comprising current tax and deferred tax should be included in the determination of net profit or loss for the period. They are telling tax expense should be taken in the P&L. Of course, we'll take it in the P&L. Current tax, that means tax payable as per income tax, and deferred tax plus or minus should be taken. Permanent difference do not result in deferred tax asset or deferred tax liability. Ignore the permanent difference. The tax effect of timing difference are included in the tax expense. Okay. While recognizing the tax effect of timing difference, consideration of prudence should be there. When you are recognizing timing difference, you should use prudence, they are telling. That means provide for future losses, all that we are going to do. Now understand this. Deferred tax asset are created when tax as per IT is more than tax as per accounting. Simple. Understand this. Okay. Now as per accounts. Okay, income. We are talking about income. As per accounts is 100. As per tax, the income is 120. As per tax, the income is 120. That means what? You always focus on tax. In taxation, income is more today. That means in future, income will be less. That means in future, income will be less. First, you focus on income. If income is more, you have paid more tax. That means in future, you have to pay less tax. In future, if you have to pay less tax, deferred tax asset. Deferred tax asset. Imagine if it is the other way around. If it is 120 in accounts and 100 in taxation. That means in taxation, income is less. That means today you are paying less tax. But when it reverses, in future you have to pay more tax. This will be considered as deferred tax liability. Simple. You have to focus on, did you pay more tax as per income tax or did you pay less tax as per income tax? If you paid more tax as per income tax today, in future you will pay less. That is a deferred tax asset. If you paid less tax as per income tax today, in future you will pay more. That is a deferred tax liability. Now, deferred tax liabilities are created when tax as per income tax is paid less than the tax as per accounting. Tax expenses, current tax plus or minus deferred tax. We already discussed this, current tax plus or minus deferred tax. Now, reassessment of unrecognized deferred tax asset. Now, deferred tax asset, sometimes what happens, we will not recognize if we are not sure if we are going to get income in the future. But if at all we have not recognized today, every year and what we will do, we will reassess the situation. We will see, yes, in future, are we going to get some income? If we get some income, that time this deferred tax asset can be set off. So therefore, only if we are going to get taxable income in the future, if we are probable that taxable income will be there in the future, deferred tax asset is going to be created. Otherwise, you are not going to create. Measurement. Current tax should be measured at the amount expected to be paid or recovered. Okay, current tax we know, at this you have to apply today's tax rate. Deferred tax is future, so we have to apply the future tax rate for deferred tax. Enacted. What came in the budget for future, that we will enact. Deferred tax asset and deferred tax liability can be set off if it is from the same business. Now, tax holiday. What is tax holiday? Tax holidays, they are telling 10 years don't pay tax. So if deferred tax is getting created and reversed within the tax holiday period, don't create. But if deferred tax is getting created, but it is getting reversed outside the tax holiday period, if it is getting reversed outside the tax holiday period, then you create that. Okay, minimum alternative tax. You know minimum alternative tax, which is MAT. Okay, government is telling that you have to pay this one. So here you don't worry anything. You see what is supposed to be paid, what is as per accounts. Difference will create deferred tax asset or deferred tax liability if it is going to get reversed in the future. With this, we are done with this particular accounting standard, guys. And with that, we are done with our marathon also. So wish you all the best for your exam. It's going to be a very easy paper. Just revise all the concepts and go to the exam. Okay, wish you all the very best. See you in future. Bye.